All people are clamoring to do is to buy bonds. I think it's too early.
I think you have to be very valuation sensitive in this market.
Buying duration in here, we're about to start swimming downstream again.
I don't think that you're going to re-enter a bear market in equities.
I think there's a lot getting built in that's momentum right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market trying to bounce again, up by 0.1% on the S&P 500. A decent close yesterday, just about in positive territory on the S&P 500. On the NASDAQ, the last 24 hours, some fascinating moves. Crude touching $95 a barrel. TK, your 10-year today, 464.27 is your new cycle high.
If anything, this Thursday is more tumultuous than what we saw Monday, Tuesday, Wednesday. You're right. We had an equity pop at the back end. Maybe it was short cover, whatever. A lot of people talking about that. John Stolfus, the optimist, to be with us here in a bit. But, John, you got to reset and recalibrate on these numbers. There was a moment yesterday. Let me get out the surveillance mouse.
Please do.
And tell you at 12:51 yesterday, we had a 2.30% 10-year real yield. I did not frame that 6 months ago.
The equity market's kind of a snooze. Bond market,
agreed.
Huge moves. Commodity market, 95 on WTI. FX, 104 briefly on the euro against the dollar. Dollar yen, Lisa, getting closer to 150. Briefly, 149.63 is the high of the session so far.
That's exactly the right observation. Why are stocks so somnolent? Why are they not responding whatsoever to what we're seeing in the rest of markets that seem to be completely roiled? Is there just simply a paralysis, or is this forced selling for funds that don't necessarily have that big of an equity position? I mean, at this point, are we looking at some unraveling that is gaining steam and that nobody wants to get in the way of?
I'm going to go to the Ellen Zentner show, which is what all today is, and particularly at 8:30 when Mike McKee not only gives us GDP, blah, 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 like he always does, but, John, there's a massive multiple set of revisions to our economy. And it is not probable, but possible at 8:31 this morning, Jerome Powell and the team down in Washington go, oops.
Growth is okay, but not as good as we thought it was.
Yeah. And,
right.
And you know, Lisa's going to tell us in the brief how many 8-9 Fed speakers today. But this thing at 8:30 today, dovetail, folks, your market trauma into what we see at 8:30 today.
And then we'll get our teeth into claims. And if claims come in and around 200K, Bramo, 201, the previous read, 215, the estimate this morning.
If we keep getting this kind of lack of response in the labor market, if it keeps staying strong, especially with all of the wage pressure that we see percolating out in the headlines and beyond, how much does this sort of keep this feeling that rates are going to be higher for longer, and that maybe, if anything, the Fed is underestimating how much it has to do to curtail inflation?
They're higher again this morning. Let's touch base with this market. Quick snapshot of things for you. Equity futures just turning positive in the last 10 minutes or so. We're positive on the S&P by 0.1%. There's your move in crude. We pull back just a little bit after briefly breaching 95, back to 93.46 on WTI. And there's your move in the bond market. Right now, 462.82, up a couple of basis points. High of the session, high of the cycle. Lisa, 464.27.
The highest going back to 2007. It's the pace of the moves, as people did say at one point they were buyers and now are just stepping back. They don't want to catch a falling knife. Today, John, I take your point about initial jobless claims. That is going to be the most important economic data of the day. At 8:30 a.m., we do also get the second quarter GDP. It is the third revision. And we may, Tom, to your point, get an upward revision. But initial jobless claims, if they keep coming in, basically nowheresville in terms of historical reference point, you can see they basically flatlined since the pandemic, or over the past 2 years in particular. How much do we get this feeling that this economy is much stronger than many people expected? Tom, you were asking about Fed speakers. We've got 4 of them. We have Chicago Fed President Austin Goolsbee, Fed Governor Lisa Cook. We also have Richmond Fed President Tom Barkin with our own Michael McKee. This, to me, is going to be really interesting. Not only Tom Barkin, because Mike McKee is always a wonderful interview, but 4 p.m. Fed Chair Jay Powell is going to be hosting a town hall with educators at a time where it's curious what his response to some of the market moves have been, right? I mean, is he going to comment on that, or is he going to talk about his education policy? I'm not sure, but at this point, I am curious if he weighs in.
On TV, bring up those 4 beautiful faces again. John, I think you were missing this. Steve Rasciuto yesterday of Mizuho was on fire.
What did he say?
And he really got emotional, and he said Jerome Powell is not Alan Greenspan. Basically, he alluded, not to put words in his mouth, that Jerome Powell doesn't have control of the debate.
He went that
Fed,
far.
where Shudo was wound up. I told the team to get a video block on that so you could steal it for your other property. But, I want to make clear here, there's a debate here about the dynamics of the Fed. I make jokes about it, but you know what, Lisa, you're right. The Fed speakers
Some
matter.
people might say that was implied by the forecast and the difficulty, Lisa, he had in the news conference explaining it.
And I would say, yes, absolutely. Steve Risciuto also went on to say that the composition right now of the Fed does not give the market confidence that they really are have conviction to get inflation back down to 2%. After the bell, I'll finish up on this. Nike earnings, also BlackBerry and Vail Resorts. Maybe we'll get a sense of what the ski season will look like this year. Just saying for a friend. Nike earnings will be key, especially because consumer discretionary shares have fallen 10% in the past 2 weeks, but still are up. So how much do we start to see some of the weakness play through?
Do you need new skis this year? I mean,
no, I got some pretty recently, thanks.
Oh, you bought some new skis?
No, not like a year ago.
Yeah, but you need a backup pair.
All right, let's move on.
We can move on. You pulled up the ski and we just thought we'd go
Well,
there.
I'm always interested in what they do because, there wasn't as much snow last year, so how they sort of fare that out. And it gets really crowded, so do you end up with these package deals or not?
And the guy in front of you skis over your beautiful Rossignol Olympic skis. That happens.
As long as they don't crash into me, I'm good.
It becomes very personal for Brammo.
I know, this is really
on a
gone
daily basis.
Downhill very quickly.
John Solfus joins us now,
So to
Chief
speak.
Investment Strategist at Oppenheimer Asset Management. Excuse the pun, right? Okay. John,
I missed it.
4,900 on the S&P 500 year-end is your forecast, sir. Can you tell me how much of a challenge you see coming from the bond market currently?
Well, I must say that near term, there is a challenge in terms of perception, but it is not really uncommon when you're going through the type of transition that we're going to, and then the seasonality that's involved in this month. You've got to consider that you're going to question, how are we doing with that? But remember, we had a 4,400 target that we put in last December that a lot of people thought was very high, that was achieved, in June or July of this year. And that's when we addressed and moved our target higher. At the end of the day, Jonathan, what I think we have here, it's the end of free money. And we think it's a good thing because bond issuers have to pay for the privilege of borrowing money. Bond buyers get something in return. And it puts a chill. And I think that's what we're seeing. I think the gambling money is right now really trying to lobby the Fed to begin to go to an extended pause or actually cut rates, instead of going through this gauntlet that they've got to run through to get to close to that percent target.
John, we're staggering into October. It's like September didn't exist. It went by so fast. And my theme for the year, a year that's coming to a close, is the great zombie roll-up. You just alluded to it, that money costs something, and the zombies are going to get rolled up or go out of business or whatever. How do you play that on a sector basis? Do you buy the zombies or do you buy people removed from that debate?
Well, I buy people removed from that debate because my mandate is more conservative in the sense that it's involved in dividend stocks that grow their dividends faster than their peers. And on a global basis, the indices that we use are not the most speculative indices, but are more the traditional indices that we use for most institutions. But that said, we think there's a tremendous appetite for distressed assets. And you've got to figure the distressed buyers, usually in crises that we've experienced over the last 40 years, actually never really satisfy their appetite for distress coming out of it. Because usually the Fed, the Fed's not infallible and make mistakes, but usually the basic mandate of the Fed really defines the fact that they will be successful.
John,
and so
at Bank of America long ago, when you were with Robert Sinch there, you used to trip over the value line once a month. I mean, the value line folks was on the floor and you trip over that puppy as you did your securities analysis. What are you actually studying right now in this bond and FX turmoil?
What we are really studying is the cause, looking at the effect, and recognizing from what we see, our view of it is that the Fed has been remarkably sensitive to the outcome of its practice, of its mandate, to the underlying economy. So, and then it's been helped out a lot by all the fiscal stimulus that created a bridge over troubled waters and a Fed funds hike cycle process. So, and then you have technology, whether it's advanced logistics, things that help companies, good companies, weather tough storms a lot better than they could in a much more primitive era. So we look at a lot of things, but most certainly we look at the economic data. We see slowing, quite evident here, but not surprising. But yet we don't see the economy falling off a cliff, Tom.
John, is your bullish call on stocks predicated on the idea that the Fed will cut rates next year?
It's based on the fact that I think the Fed is getting closer to the end of this cycle, which would likely mean an extended pause to get some assurance that Jerome Powell doesn't have to be worried about being recognized as another Arthur Burns. I think that's preeminent in his thinking. He wants his legacy to be a good one, and I think he's got a good chance for it. So we think probably you'll get cuts towards the end of next year, mostly because we would expect that the Fed will have been more successful than not at curbing inflation, putting it in check, and it will be time to probably bring it down some, because we think there's one more hike to the end of this year likely, and then probably a hike next year, maybe even two.
John, 4,900 on the S&P, given the potential for another hike this year and maybe even, what did you say, two next year?
Yeah. Yeah, well, Jonathan, we publish weekly in our report and in our monthly chart book two tables that show the performance of the market for maximum drawdowns and a variety of things, whether it's the Fed funds rate, whether it is the CPI, and it's all listed there. And our clients can look at that and discuss it with their advisors. And what we have found, in my experience in 40 years in this business, is stocks can actually go up when interest rates are higher. I mean, yes. Tom and I can remember during the period when Paul Volcker was hiking. Yes. I can remember speaking with clients who really thought the Fed would fail. Everybody always thinks the Fed is going to fail until it doesn't. But stocks were going up while you still had coupons available on Ginnie Maes that were anywhere from 11 to 12%.
Are you the official Oppenheimer cheerleader? Is that what
no,
that was?
This is a theory that nobody believes. John and I lived Volcker, okay? And trust me, I made some dumb decisions at that time. And I've said this, John, all year. You've heard it 47 times without a drink in my hand and 122 times with a beverage in my hand. Companies adjust. That's what's going to happen.
Yes, sir.
John Stolfus of Oppenheimer Asset Management. John, thank you. Companies adjusting, Tom. Can stocks adjust? Can valuations adjust? Given the multiple expansion we've had through the year so far.
Well, for a chosen few, we got way ahead. Look at the equal-weighted SPX, I believe, to a negative statistic yesterday afternoon. What I love there is Stolfus and his bridge over troubled waters. And, you know, that's a very good illusion for the stress people face now. Because, John, when you're down and out,
oh boy,
and when you're on the street,
lyrics,
when you're toxic,
Except like,
brew,
flashing.
No, this is yours.
When your toxic brew falls so hard on you.
Oh, dear Lord. I will just say this, that there is a real question about the liquidity backdrop as well, about where the money is going to come from to juice those stocks to that higher level.
There's a wall of money out there.
Okay, that's what people say. But what does that mean? If you can park it in 10-year treasuries and get 5% or almost 5%, if you can do that, what is the point of taking a moonshot risk on companies that are facing a lot of headwinds?
Selected companies, and the issue here, the most important thing this week, folks, is Mike Wilson sitting to my left going, I'm not in cash. Wilson's in the market while he's cautious.
Well, he is the chief equity strategist. I would hope that he's got some equity.
Well, that's a mandate, you know?
I would hope. Greg Valliere of AGF Investments is joining us next. Were you up night watching the debates? Is that what this was?
I will lay me
Okay.
down.
The latest on the debates up next.
Bidenomics has failed. Wages are not keeping up with inflation. Auto workers and all American workers are feeling it, and families are struggling in this economy.
We need a totally new approach to China. We are going to have real hard power in the Indo-Pacific, like Reagan, to deter their ambitions. We're going to have economic independence from China.
What we need is to deliver economic growth in this country, unlock American energy, drill, frack, burn coal, embrace nuclear energy, put people back to work.
Former Vice President Mike Pence, Governor Ron DeSantis, Vivek Ramaswamy on the GOP presidential debate stage yesterday, targeting Bidenomics. We'll bring you some sound a little bit later from Nikki Haley as well. Greg Valliere of AGF Investments weighing in after the GOP debate, writing this: Trump is still the odds-on favourite to win the GOP nomination. It's unlikely that there will be a late entrant. Could Trump also win the general election? We don't rule it out. Democrats in this town, TK, are worried.
Michael Scherer, The Washington Post, great feed. Tulul Ranip and the others over at The Washington Post watching this festivity. John, did you watch last night?
I did not watch last night, no.
Did you watch?
No, it was too late for me.
It was
My
too late
bedtime
for
is
me
earlier.
too, yes. Michael Scherer, after nearly 2 hours of debate, it is clear that Doug Burgum is wearing the largest American flag pin.
That's the
analysis.
That was the extent of the analysis.
Very competent Michael Scherer. We're going to get worse analysis right now from Gregory Valliere. He's Chief U.S. Policy Strategist at AGF Investments. In his blistering love note this morning for all of you watching this political ballet is it was cringe-inducing. Greg, expand on the cringe-inducing moment last night.
Well, hi, Tom. Good morning. Sorry, I've got phone problems. Yeah, it was cringe-inducing, absolutely. It was 2 hours of nonstop espresso. I had several cups of coffee just trying to stay awake for this.
If it's a GOP debate, who are they speaking to? What percentage of the voting public? Are they speaking to 15% of the public, or dare I say 30%?
I think they're speaking to Nikki Haley, and I think they're speaking to Ron DeSantis. They both had pretty good nights. And they had to have pretty good nights, and I think it's a little too early to write them off. I think Haley is an outstanding debater.
Greg, what's interesting to me is that everyone just assumes that Donald Trump is the winner of this debate by not showing up. And this comes at a time where there are a lot of questions around his viability as a candidate. You say that Democrats should be worried. Why should Democrats be the ones who are most worried after this debate?
Well, the polls. I think the polls now show basically a dead heat between Donald Trump and Joe Biden. There was one infamous poll a few days ago in the Washington Post that showed Biden trailing by 10. Nobody believed it, including the Post, but the polls are showing this is a dead heat. And to think all that Trump has been through, all of the indictments, 93, I think, as specific indictments, this race is a tie. That's not a good story for the Democrats.
Let's talk, Greg, then about what the former president was doing in Michigan yesterday when he did speak with a non-union auto manufacturing parts company. And he was talking about the need for fossil fuels, kind of a similar theme to what we heard from Vivek Ramaswamy. How much is this going to be sort of one of the hallmarks of the Republican platform, basically the anti-green platform?
It's a big deal, Lisa. I think, first of all, Michigan has 16 electoral votes. So that's important. And I do think that being against all of the new stuff is probably a good place to be in a state like Michigan.
This isn't Nixon Kennedy, 1960. It's not somebody holding a dog's ears up in the uproar over checkers years ago. There's a process here, Greg Valliere, and the process is these people are going to drop out. I see no incentive on an ego basis for these people to drop out. What's the actual incentive to get off the debate stage in 6 weeks?
I think a lot of them would like to be players for the next few years, have their own talk shows, things like that. But I'll make you guys a wager. The first major candidate to drop out will be Mike Pence. He had an awful night, no energy. I think Pence could be out by Thanksgiving.
Okay, that's a fine prediction as well. Are all these people running for cabinet office? I mean, I don't get it. Is Scott of the Carolinas, is Scott running to be Secretary of Commerce or Secretary of Treasury, whatever?
Sure. And to be uncynical for a minute, I think they have a message. They have a message they want to discuss.
Okay.
Scott did on race last night, and I thought he was quite eloquent. So, no, they want to stick around for a while longer, but the key is going to be running out of money. Pence is almost out of money. I think others, have enough to get through the end of the year, but I think you'll see a lot of big contributors not giving much more money.
3 months ago, people would say, just wait, we don't really know what this race is going to be. It could be through somebody very different than the former President Trump and President Biden. Some people were talking about Virginia Governor Glenn Youngkin as a possible interim. People were talking about California Governor Newsom coming into the sphere. Why do you say the train's leaving the station for anything other than a Biden-Trump matchup?
Oh, in a word or two, it's filing deadlines. A lot of states have filing deadlines by late October, early November. So I do think the train is leaving the station, both for Glenn Youngkin and for Gavin Newsom. I think they've got to wait for another 4 years.
What did you make, Greg, last night of, on the debate stage, the negative feelings toward a shutdown, the sort of antipathy toward some of the right-wingers in the Republican Party who are trying to shut down the government as soon as Saturday night?
Well, we're now entering one of the great Washington games, Lisa, and that is the blame game. Who gets blamed for this? And McCarthy, all of a sudden, in the last 24 hours, has decided to blame Biden, blame the Senate, blame the Democrats. He's trying to shift the blame to everyone, and that's going to be a big theme in the next few days.
Greg, just want to finish up on Nikki Haley. Once again, a lot of people think she did a tremendous job in that debate yesterday evening, based on the reviews that I've seen. If you look at the polls at a national level, taking on the current president, Joe Biden, she does tremendously well. Greg, what can she do at the primary level to make sure that she's it for next year?
I think you hit on it, John, and that is her argument is going to be she could win a general election, and I think she could do well. She is an outstanding debater, and I think she's going to be in this race for quite a while.
Greg, thank you, sir, for your view on things this morning. Thank you. Greg Valliere there of AGF Investments. Round 2 for GOP. Yeah. Certainly lacked the buzz at a previous debate, Tom. But based on the performance of Nikki Haley and the reviews that I've seen through this morning, based on the polls that you see at the national level, Greg put out the argument for her, I think, going forward.
The thing I detest, and I got one observation, John, to you that I think is important, but the thing I detest is where the sort of right TV does this litmus test voting thing where they'll bring up a topic and they want you on record to raise your hand. It cringe-inducing. It is. I have a question for you.
Sure.
He said something important there.
What was that?
These people run out of money. In the United Kingdom, in the beautiful, short, contained ballet you have, do people run out of money?
Short answer, it's not the same issue at all. The way elections are ran, the way they're financed here is just completely different. Totally foreign to anyone that follows British elections.
But I mean, somebody, I'll pick York, and I don't know it. It's up north, it's York, it's a really important borough, whatever you call them. They don't run out of money, right?
Well, this leadership race would happen pretty quickly, Tom, in the UK.
Lisa, we are so flawed on this. I don't even know where to begin.
Well, what would change it? What would change it?
Senator McCain and others tried to change it, and they got crushed in court. That's a short answer. That they tried.
Honestly, I think that right now the most interesting takeaway is as much noise as we keep hearing, whether it's the shutdown, whether it's the political back and forth, whether it's the internecine arguments in both parties, the dollar still is preeminent. And I think that the bottom line is people still view the nation as the world's main economy. And so, you say all of these things, and yet here we are. It doesn't seem to have really jeopardized the nation's standing, which really is the question. At what point is there sort of like a vigilante kind of movement to force change? Because right now it ain't there.
I've said for a while you have the luxury here of being reckless on certain issues.
It's probably true.
You do when it comes to shutdown and debt ceiling debates.
Yes, we do.
We know what the reaction is. It's by treasuries. Whenever there's a problem, it's by the US dollar. Did you see Governor Newsom in the spin room? I saw some of those clips. Speaking of Sean Hannity, again, those two should have a show, honestly. He was talking about crude production, energy independence in the United States. The GOP are coming after the energy story of the Democrats and this White House, the president. Yeah. Governor Newsom's making a point. Look at where energy is currently in America. Now, you can say it's because of this White House or despite it. Right. The fact of the matter is we've got crude production in America pushing 13 million barrels a day. Coming up shortly, Ian Shepherdson, chief economist at Pantheon Macroeconomics. Your equity market totally unchanged on the S&P. A little bit of a snooze, and maybe that's welcome news. Our next guest teeing up his own interview on X, Twitter, saying this. Talking macro, and I hope Newcastle United's glorious victory last night in Shepperton coming up shortly. We'll talk about Newcastle just for you, Ian. Let's start with the price action on the equity market. In the S&P 500 on the Nasdaq. We're positive just about on the S&P at the close as well yesterday. Decent rally into the end of the trading session. The Nasdaq also closing positive this morning, slightly negative by 0.1%. Headline after headline in the bond market. Let's get to it. 2-year, 10-year, 30-year. Here's your 10-year right now. Wow. 464. 463.65. Here's your 30-year. 475. Yields are up by about 3 basis points. Tom, I remember hearing again and again and again repeatedly, particularly around the banking stress of spring, that was it. You've seen your cycle highs in this bond market. And here we are through those levels.
On a nominal basis, there they are. There are 3 numbers lined up, but what matters is the comparison and the dynamics. John, we have further curves of disinversion. This morning, we've gone from negative 100 pre-Misra. Think of that base, deep inversion, and we're now up to negative 49 basis points. We're up 4 basis points today. Most pros will tell you disinversion brings instability, and that's what we see in the market.
The surprise for me, Tom, is how it's happened. If we sat around this table around spring and said, okay, disinversion, curve steepness, where's it going to come from? The jargon you would have heard, Lisa, is bull steepener. We would have heard the front end's going to rally because the Fed's going to start cutting interest rates, and you'll see that. That's not what's happening here. It's the long end selling off. It's the 10-year, it's the 30-year. And if you want to draw a line back to what's happening here, I can't point to the data. The data's been decent, but you haven't seen massive changes there. Can you really say we've had a change in tone from the Federal Reserve? I don't think I'd go that far. I think you have to go back to the Treasury refunding announcement later in the summer, which really sparked that drama at the long end. Now, whether you believe that should be driving this kind of price action, just to join the dots here, Bramo, that's where they go.
I will add to that the idea of quantitative tightening, where you've seen $1 trillion run off the balance sheet of the Federal Reserve over the past year or so. So you can see that coming to the fore. Steve Raschuto put it really well yesterday. He said, since the Fed's statement, this market is losing faith that this Fed has the conviction to inflict the kind of pain necessary to bring inflation down to 2%. And every upside surprise just adds steam to that. And so basically what you're seeing is not a term premium. It is an inflation premium that is getting built in to the bond market.
Sonal Desai, Franklin Templeton, a little bit later this morning. Look out for that conversation. She has thoughts similar to the kind of thoughts that Lisa just lay out. I want to finish on foreign exchange. Dollar, strongest of the year so far. The euro briefly, 104. Dollar yen getting closer and closer to 150 and backing away. You can flip it around this morning. The dollar's a little weaker after all the strength we've seen. But TK, what a move we've seen in the dollar over the last couple of months.
And the pro nuance here is euro weaker, yen stable. It's been weaker yen the last couple of days. Every day, folks, there's some nuance here as the pros triangulate. In the last 24 hours, it's about that euro weaker.
106 on DXY. Under surveillance this morning, oil stockpiles at major US storage hubs dropping to critical levels, pushing the price closer to $100 a barrel. Inventories at a hub in Oklahoma falling just below 22 million barrels, the lowest mark since July of last year, and close to operational minimums. This is what Amrita Sen yesterday was talking about, Lisa. The tension in supply, in inventories, really breathing some life into this rally.
I wanted to actually go exactly to that interview with Amrita Sen. She also said that people are underestimating potentially how inelastic prices are. I thought that was a fascinating point, that because of the lack of supplies and because of the fact that people are going back to the office, that things are coming from a low base of necessary travel, you're going to see prices stay higher for longer before that demand destruction comes into play. We are hearing that on the edges from others as well. So at what point does that become a real feature for the Fed, for other central banks, for inflation expectations?
I wouldn't go that micro. The Pacific Rim is going back to the office post-COVID. That's
China.
how I'd put it. Yeah. Well, Indonesia, pick your country.
Amrita made that point as well. More on that a little bit later. Government shutdown. We've got to go there, unfortunately. A last-minute deal to avoid a government shutdown looking unlikely as lawmakers struggle to find common ground ahead of Sunday's deadline. A bipartisan stopgap measure agreed to in the Senate still has to make its way through the Republican-controlled House, where Speaker Kevin McCarthy could be ousted if he takes it to a vote. Lisa, what on earth is happening?
Why does Kevin McCarthy want this job? I'm serious. What power does he have?
People asked that question when he was facing those votes at the time.
Well, I'm still going to ask it because right now people are saying he's got zero leverage negotiating with the president because he doesn't have the whole party behind him. What power does he have to act as a leader at a time where he cannot bring everybody together and he doesn't necessarily have the ability to face off with Democratic leadership because of that? And I don't know how this is going to end without something that really forces his hand.
I'm going to defer to AMH. Anne-Marie's going to answer that question in the next hour. If you're listening, Anne-Marie, yes, you are. Final story for you. Former President Donald Trump skipping last night's GOP debate, instead speaking to auto workers in the battleground state of Michigan. Trump attacking the Biden administration's push for EVs, saying it will lead to the, quote, assassination of the automobile industry and see jobs, Tom, lost to China.
Yeah, and I would also point out, particularly for our international audience, he had a very difficult day in selected courts in New York City. I don't pretend to be expert on it, but clearly what the pros are saying of the myriad cases he has, yesterday was a difficult day for him and his family as well.
China really, Tom, on the EV battlefront, big deal.
Yeah.
Big deal.
I agree, and we learned that in London. I learned a lot in London, advanced on EVs from us about this China.
Well, particularly for the EU, and we've been following that story, the inability to compete directly with some of these Chinese manufacturers and the push that you're seeing from Ursula von der Leyen, potentially, Lisa, to increase tariffs.
So here's my question, and then what you also saw from Rishi Sunak, the idea of backpedaling on some of the targets of when you get to certain EV adoption. How difficult is it for some of these auto manufacturings to maneuver with policy that changes day to day, depending on what the political wins are? And at what point is consistency the most important thing, which is not attainable at a time of such divergent political wins as well as just economic ones?
One of the important things about our guests, and we treasure what we call our best guests like Ian Shepherdson and Pantheon Macroeconomics, is we follow them where they go. We were going to do a remote, John was going to do a remote with Ian Shepherdson last night from the east stands, overlooking Milburn Stand, and off to the left, Gallows Gate Stand at Newcastle, where Newcastle trounced Man City, I say. Not an upset, but a giant win for the brethren of the eastern shore of the United Kingdom. And they had possession, John, 32% of the time, and they still beat Man City. We go to a gentleman who knows the tots, knows English football, John Ferro, to speak with Ian Shepherdson.
Ian Shepherdson, this is why you're here. This was the appearance fee. We're going to mention Newcastle United. You're in the stadium. How great was that atmosphere, Ian?
It was marvellous. Well, only in the second half. The first half was very tense and frankly a bit dull, but the second half was absolutely glorious.
That's it. Now we need to get to business. Let's talk about this bond market. Ian, we've talked a million times about the slowdown that's just around the corner, the US consumer that's about to break. Ian, then I look at jobless claims, around 200K, unemployment still south of 4%. Ian, where is it?
Well, it's not in those data yet, and if we get a government shutdown, we won't see what's in those data at all next week because a payroll report won't appear. But looking at some of the real-time stuff, there's been a couple of really interesting developments just over the last 8 weeks or so. So there's been an enormous surge already in student loan payments, which legally don't have to start till October, but people have started paying them much earlier than that. And already we've seen a big drop-off in things like restaurant demand, airline travel growth, hotel occupancy rates. Auto sales, looks like we're going to see the first quarterly decline in auto sales for over a year in Q3. None of this stuff is a coincidence. It's 40 million people have got to find $300 a week now to make a month to make their loan repayments, which they didn't have to make in the summer when the consumption numbers June, July were looking pretty great. So I just wonder whether there's a turning point happening now, which isn't visible yet in some of the official hard data, but is visible in some of the real-time stuff. And if that's the case, then Q4 is going to be very interesting. You've got the strike, the UAW strike, you've got the shutdown, the student loan chaos. It's very messy.
To the tumult right now, Ian Shepherdson, and this goes to the Pantheon commitment to China analysis, you make clear we underestimate the industrial August jump in China. Frame out a surprise jump in China's economy.
Yeah, well, a jump might be pushing it a bit, but the industrial profits numbers have certainly appeared to have turned around kind of across the board with better revenue numbers and better pricing numbers. And so I would describe manufacturing as certainly putting in kind of a solid floor there. And that's not just a China story. We're seeing that in some of the data outside China as well. The US industrial numbers have stabilized. I wouldn't yet say that there's a meaningful recovery in there, but there's certainly a degree of stability. So, China, although China's economy is disappointing, let's be clear, they're growing. I mean, they're probably going to grow 4% or so this year, not the 5% that they want, but they're not going to be a million miles away from it. And a key part of that is this stabilization in the industrial sector and a rebound in profits. So the news isn't all terrible. I mean, a lot of attention on Evergrande and Country Garden, and that is terrible. And that's got a long way to go. But at least on the industrial side, which is a huge part of their economy, a much bigger part of their economy than it is of the US or Europe. But looks like some element of stability is creeping in there now.
Let's bring the news to 8:30 this morning. It's 2 hours from now. Ian Shepherdson, there's GDP. Some of us flunk macro when we go to GDI, which is another way to calculate the spirit of the American economy. Many are looking for a markdown in GDP. Are you?
I think there might be a little one, but I'm more expecting a big upgrade to the GDI, the income numbers. There's a lot of changes. So what's happening in today's report? It's the once every 5-year comprehensive revisions to the whole national account. So there's a huge ton of changes. It'll take a long time to sift through everything. But the biggest single change that they're going to make, it looks to me anyway, is to start including interest payments from the Fed as a part of private sector income to financial institutions. And because those interest payments have soared over the last few quarters with the Fed raising rates so much, that's kind of been so far uncounted income to the private sector, which may be why the GDI numbers have been so weak relative to GDP. Now, that gap has prompted a lot of people to get very excited, arguing the economy is much weaker than it looks. But actually, I think it's probably going to be resolved in the other direction, with the GDI coming up and the GDP not doing very much. At least I hope so. I mean, they're making dozens of other changes and they could all offset each other. It's a real wild card. But, if the economy really were as weak as the GDI numbers, we wouldn't be seeing jobless claims at 200, 220. We wouldn't be seeing 200,000 a month payrolls, and we probably wouldn't have 3.5% unemployment. So I kind of think the story of hidden weakness is probably wrong.
Well, if that's the case, then what makes you think that fourth quarter is going to really be a quarter of weakness?
Well, the fourth quarter's got these weird things. It's got the strike, it's got the shutdown, it's got the start of student loan payments, which is these things are all one-time things, but they can make a meaningful difference. The student loan story in particular, this is 40 million adults suddenly having to divert $300 a month from spending at restaurants and travel and other fun things into making loan repayments, which they haven't had to do since the start of the pandemic. So it's a one-time thing, but it's an adjustment that'll take a few months to play through entirely. And also, you've got to remember here that we're hitting now the lagged effect of the more rapid tightening that the Fed did in the summer and the fall of 22. So it takes a long time for the Fed's actions to work through. Markets are very impatient. Everyone's very impatient. I normally work, rule of thumb, 6 quarters from a Fed rate hike to see the full effect on growth. So all we've seen so far is the impact of that initial tightening. It was 6 quarters ago when they started raising rates. There's a lot more to come. And that's what's making me nervous about next year. So, the markets have been focused on the upside surprises to growth in the summer of this year, and markets still aren't convinced about disinflation in the US. You were talking earlier about that. But I think that those stories both change next year. I'm expecting a kind of a weak growth environment and sustained disinflation. And in that background, a 4.60 10-year note just doesn't really make any sense.
And I've got about 30 seconds. I want to go there, though. When you say things like that, we haven't seen it yet. Where haven't we seen it? Where you expect to see it in the next 6 months?
Well, we've seen the start of it. The inflation numbers that Powell has talked about, 2 or 3 good months isn't enough. And that's true, fair enough. But my guess is that in 6 months' time, we'll be looking back
just
at
to
8 or 9
jump in,
months
because I'm really against the clock, so forgive me.
Point,
but a lot of people might say that all we've seen so far is inflation come down because the supply side has improved. Where do you expect to see actual Fed hikes start to come through the economy to bring down demand? What spot in the economy?
Yeah. Well, wage growth is slowing now. The ECI is rolling over. The quits rate's back to where it was before the pandemic began. The labour market is rebalancing. It's normalising. That drives the core services inflation. That's what the Fed cares about.
OK. Ian, thank you, sir, for the update. Congratulations on the win as well. Ian Shepherdson of Pantheon Macroeconomics. Coming up next, have you heard about the iPhone 15 getting too hot?
Oh, yeah.
Heats up too much. Too hot to handle, Dan Ives of Wedbush might say. Dan Ives joining us next on set in New York. This is Bloomberg.
my highest conviction is that I think we're going to start seeing some of the big tech continue to sell off here, just not because there's something bad per se happening, and just simply valuation adjustment against higher longer-term interest rates. So, I went out with NVIDIA puts in early August, and I'm holding on to those.
A difficult few months for big tech. That was Michael Purvis, the founder and CEO of Torvac Capital Advisors. We need sunglasses for our next guest. Dan Ives of Wedbush, remaining bullish, saying this, quote, our view of tech stocks, that the transformational growth around AI will continue. Cloud, cybersecurity, a rebound of digital ad dollars will create a springboard of growth into 2024 that is currently being underappreciated by the street. Dan Ives, TK of Wedbush.
Out on the web, quote, the iPhone is getting really hot when using it even for a short while. Date, July 4th, 2007. This has happened before. The uproar this morning. The man with titanium clothes, Dan Ives, joins us this morning here on the latest uproar. OMG, it's hot. First thing I said is, yeah, whenever they bring out a new phone, the software's screwed up, it's hot. It's like not news, is it?
But this is not a surprise to Apple. I mean, Apple knew from a titanium that this was going to happen. There will be some software updates that come out over the next week. And it's typical Cupertino. They're going to fix it. And if you look ultimately at the demand for this iPhone, it continues to be, I think, much better than expected.
Seriously, we got to do this. Is there any danger to the public with this, like exploding or on an airplane, lithium, the gloom that's out there?
Not at all.
There's no danger.
Not at all. If you look at even some of the ones that have tested this, in terms of stress tested it, there's nothing like that. It's really just more, it overheats in some instances. But I believe this bug, the fix that they'll come out with it is going to resolve.
So if John's at Covent Garden buying a new iPhone, he can go in safe.
He can go in safe, and he's going to be able to watch Premier League and do all of everything he loves doing.
All his London things.
Why not just go back, Bramo?
That seems to be.
Dan Ives, you just said something. You said demand will be better than expected. In fact, you implied that it is better than expected.
Already.
So can you tell me about, A, what was expected, and B, how you're gauging current demand? What are you looking at?
If you look at lead times in terms of iPhone deliveries, we are still ahead of iPhone 14, and it's actually extending. And if you look last year, you had a shortage of iPhones. So when you actually combine what I'll call about 10 million incremental units that we actually have now from an inventory perspective, we're tracking so far, based on our estimate, about 10 to 12% ahead of expectations.
How do you make a distinction between scarcity that is, let's say, massaged by the company that produces this particular handset and scarcity that's driven by real demand? Because doesn't Apple play this game? It's difficult to get our products. There's a big lead time. There's a delay. Try getting some AirPods. It takes 2 months. Everybody wants them. Isn't that the whole marketing strategy?
Look, and I think that it's a Rubik's Cube to figure out, and that's why we spend so much time in Asia trying to understand what incremental units have actually been produced, what the demand looks like relative to the supply chain. And I think right now, we're running probably about 3 to 4 million units ahead. If you look relative to where iPhones are going to shape out. Also, ASPs, even in China, continue to go up because of the Pro. And I think that's really the story here, is that the ASP tailwinds are there. And despite doomsday sort of view out there, I mean, you're basically seeing an iPhone demand story going into holidays that's going to be ahead of expectations.
How much is Apple eating the lunch of everybody else in terms of a market that is actually shrinking, or at least in stasis, when it comes to the smartphone market?
It's a great, we've seen it in China. They've gained about 300 bips in market share the last 18 months. And I think even despite Huawei, I think we'll continue to gain share, because Huawei, if you buy that phone, it's like buying an iPhone 12. And it comes down to the chips and what they've done from a silicon perspective. It's the best smartphone in the world, I think, by miles at this point.
Which raises a question in my mind, which is maybe Apple is the cleanest shirt in a dirty hamper, or whatever the expression is, yet the overall macro backdrop is souring in a way that is more meaningful. We saw that from Micron yesterday. Some of the expectations coming out seem to be more negative than people previously expected. Where do interest rates have to stay to keep your bull thesis afloat without the macro gloom getting in the way?
Yeah, and look, and we've talked about it before. Obviously, it's a macro backdrop that's really causing white knuckles across tech bulls. And I think I see from investors on a daily basis. Well, look, I mean, my view is that going into this next year, I believe, Fed's going to cut, at least from a backdrop perspective. But I'm more macro aware, micro obsessed in terms of how we've done it. And if I look at growth in tech, I believe it's going to be the biggest growth we've seen in the last 30 years. And that's why a lot of the bears that have called 10 of the last 2 downturns, I get it. I get their thesis. I just think we sit here 6-9 months from now and Apple's an all-time high.
Calendar item, October is upon us and institutions are behind. Without question, they're under-owned on Apple. Insider share ownership off the Bloomberg, Apple 66%. Satya Nadella and Microsoft 75%. They're under-owned. End of the year, do you get a massive short squeeze to get you from 170 out to your 240 target?
I mean, our view is this is a stock that's ultimately going to have a 2 in front of it over the next 3 to 4 months. I think earnings season for tech is going to cause, I think, a major
Yeah, but what does a big institution do? JP Morgan Asset Management, name the company worldwide. They're under-owned in this dog. They have to buy it in the year end, right?
It is a gift, what I view, Apple here, a golden buying opportunity. And institutions that I talk to continue. It's a Groundhog Day situation. New York City cab drivers bearish on tech and Apple into earnings season. And I think we sit here end of the year and we look back and this was an opportunity going into what I view as a mini super cycle, especially as everyone's positioned right now in big tech.
Is China a Groundhog Day situation? Isn't that new?
Well, I think when you look at China, I mean, even if you go back, the worries about government ban and everything we've seen, but yet you see the lines, you see Chinese consumers that are actually lining up to buy iPhones. So I think when I look at China, Cook, 10% politician, 90% CEO, that continues to be the hearts and lungs of the story. So I just view that as one where it's the big bad wolf. It's always the fear out there, but at least the bark is going to be worse than bite so far in this cycle.
I want to just end broadening out to where the macro fears are right now. This idea that we are seeing more strength that is going to cause more profit margin compression that's going to lead to a lack of investment by a lot of companies. How much does that delay, or would that delay, your thesis of growing profits to new record highs as a lot of companies invest in artificial intelligence if they don't have the extra capital on hand to do so?
Yeah, it would. And that's why we spend all of our time, not here in New York City, but around the world, trying to understand where the demand trends are. I believe we're going to sit here with cloud numbers from Microsoft, Amazon, Google that beat expectation. We actually see the opposite that's playing out. And I think that's really going to be the surprise earnings season. Of course, that's the biggest fear, but at least what we see fundamentally speaking is actually the opposite playing out, despite some of the macro fears.
Aren't we comparing some businesses that are still delivering double-digit revenue growth and one business, Apple, the core of it, that's not really delivering any growth at all? It's 2 very different stories, aren't they?
No doubt when you look at cloud and what's happened in AI. But, John, I think we sit here a year from now, and that's a re-accelerated growth story, not just on iPhone, but also services that's going toward double-digit growth. And I think Apple's one where the bears for years have gotten it wrong, saying the best days in the rearview mirror. They continue to underestimate the golden story of Cook and Cupertino.
It's slightly unfair, Dan, because they've been right, because sales have flatlined. Hasn't the company gone ex-growth when it comes to the iPhone?
Yeah, but I'd say they've been maybe right conceptually, but wrong on the stock, and I think wrong on the valuation, because I just view right now, this is just a pause from a growth perspective in what has really been a multi-year upgrade cycle that's gone on in iPhone. And I think it's just...
No, I don't mean to interrupt. It's just been a failure of a stock. 10-year annualized return, 29%. You know,
Tom, it was backed up by tons of growth. The point is, and I think the question is, and it's a valid one, is that growth isn't there anymore.
Their operating leverage.
And I'm not here to make a judgment about the future. That's for you to do.
Their operating leverage.
I'm just here to make an observation about the last 12 months.
Their operating leverage down the income statement from single-digit revenue growth is historic. It's like back to Graham, Dodd, and Cottle. We've never seen it.
And it's the Apple Silicon chip story. Now they're beating Intel at their own game. They control the ecosystem.
Oh, wait. Is the nanotechnology, the 3-millimeter nanotechnology, is that the cause of them being hot?
I believe that it's really more titanium in terms of...
He thinks I'm serious.
in terms of it's Look,
I just busted your chop. Do you have the new iPhone? That's all we want to know.
It's coming this week.
It's coming. It's on delay.
But it's on delay. It's on delay because of demand.
There we go.
Because Ferro, Keene, everyone's ordering it.
Dan Ives, you're killing me. Dan Ives and Wedbush. Dan, it's good to see you, as always. From New York City this morning, good morning. Futures just about unchanged.
All people are clamoring to do is to buy bonds. I think it's too early.
I think you have to be very valuation sensitive in this market.
Buying duration in here, we're about to start swimming downstream again.
I don't think that you're going to re-enter a bear market in equities.
I think there's a lot getting built in that's momentum right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
So much feedback on Dan Ives' shirt this morning. Live from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market just turning positive at the close yesterday. It continues this morning. In the last 1 hour or so, we're up by 0.1% on the S&P. Elsewhere, new cycle highs in the bond market on a 10-year, on a 30-year, $95 crude briefly on WTI. And in the past day or so, Tom, we've got DXY at highs we haven't seen for at least 12 months.
It's good to go to DXY, blended major trading currency, about 54% euro, 106 level, unimaginable 90 days ago. John, I just would really emphasize on a Thursday with massive economic data at 8:30, what I would emphasize is the equity market with a VIX of 18.18 removed from the turmoil in bonds and FX.
Big turmoil. I'd put it that way, Tom, and I'm with you. Away from equities, we've talked about this already this morning. Worth going over again, Bramo. Stocks have been a bit of a snooze. 7% move, yes. It's sizable. It's noteworthy. But based on what you're seeing in Treasuries, yields you haven't seen for 15 years, 16 years, something like that in some parts of the curve. The dollar index, highs we haven't seen since the back end of last year. Euro dollar briefly 104. Dollar yen getting closer to 150. That's more than notable.
Which to me raises a question, is this basically the market saying that the economy has weighed in and that it can handle rates at these levels, that this is actually manageable? If this is the new normal, it'll be okay. Companies, to use Tom's phrase, will adapt and adjust. Everything will be great, and you'll continue to earn profits, especially in an inflationary environment. At what point does that break? Does it because things are moving quickly? That really remains to be seen.
Do multiples have to adapt and adjust to this new universe in the bond market?
People have been saying that would happen for a long time. People also said that house prices would adjust. None of those have happened. You've got multiples that continue to expand. You have house prices that are reaching record highs. You're looking at this and trying to make sense of it from a fundamental basis and not really doing a good job of it.
Out of the zeitgeist yesterday was housing affordability really breaking through to new ugliness as well. John, 30-year mortgage, 7.83%. It was 7.75 2 cups of coffee ago. What Stan Fisher would do is take the percentage move of the percent. From the beginning of 2002, the mortgage rate is up 146% from a 3 level to a near 8 level. Wow.
Wow. That's the price.
That's a tangible asset. I sent a note to our great Brian Chapata this morning on commercial real estate. That's where I think the sweat is.
I think you know exactly where I'm going next. That's the price. Lisa, who's paying it?
That's the problem, is that when you talk about lag effects, and we were talking about that with Ian Shepherdson, and you asked a very good question, at what point are we going to start to see the lag effects? Where in the market do we start to see some of that come through? It is unclear, because right now, a lot of people have 30-year mortgages locked in. But at some point, and we're seeing this with corporations, they're starting to have to borrow anew.
But is that removed from the optimism of John Stolfisser, our most important equity interview of the day in minutes with Barbara Reinhard? These people are in the market with enthusiasm, even given all that turmoil.
With enthusiasm, let's see. We have our next guest who can really weigh in on that. My question is, yes, being in the market is one thing. This isn't a go-to-cash moment necessarily for people, as much as what is the right price to pay? What is the carnage that we're seeing in consumer discretionary, John, as you were talking about so much yesterday, rightly so? What about some of the underperformance in the areas outside of tech? Is that a buying opportunity or is that a warning signal?
Let's get to the price action right now. Futures just about positive by 0.1%. We'll pick up on Lisa's good question in just a moment. In the bond market, yields higher by 4 basis points. Your new cycle high on a US 10-year this morning. The high of the session, 464.68. Lisa, just above where we are right now at 464.47. It's just remarkable to see. Crude, if you missed it, 95 briefly a little bit earlier today. Lisa, right now pulling back 93.55.
The toxic brew. What we're looking at today is economic data, 8:30 a.m. second quarter GDP. It is the third revision. It'll be coming out. I also am watching, more importantly, I would argue, the initial jobless claims, how much we end up seeing this ongoing stasis when it comes to people newly unemployed. Today we get Fed speak of 4. We get Chicago Fed President Austin Goolsbee at 9 a.m., Fed Governor Lisa Cook at 1 p.m., 3:30 p.m. Do not miss this. Richmond Fed President Tom Barkin with our own Michael McKee. And at 4 p.m., Fed Chair Jay Powell talks to educators. We want to hear less about his education policy, more about what he thinks about some of these recent moves in the market, whether he endorses them, thinks that things are getting unmoored, or whether he's actually happy because this might get them to their goal sooner than expected. And after the bell, Nike earnings and Vail Resorts, but Nike earnings. And I'm curious.
BlackBerry?
And BlackBerry, yeah.
BlackBerry's still in business?
It's now like a software. It's not the same kind of company. It's not like a.
Is it like the Montreal? They had great seats at the Forum. They're in Montreal.
Do they
right?
still have that?
Yeah, I think so.
I'm not sure if they still got
well,
the money.
The Forum's
for that.
not there anymore.
Okay,
it's like,
we can have
it's
a
a new
conversation
bastardized
later.
Forum.
Barbara Reinhardt's with us now, head of asset allocation
It's our
at
hockey
Voya
talk for the day.
Investment Management. Barbara, good morning to you.
Good morning, Jonathan.
Neutral on stocks. It's a change for you. Walk us through it.
It's a big change. So earlier this year, we felt as though sentiment was very oversold, that the upleg in the equities was underappreciated. We felt that a big underappreciated story had been how much the U.S. was going to outperform the rest of the world. Remember, at the beginning of this year, everyone was cheering for Europe, was cheering for the emerging markets. We didn't lean into it. We leaned into U.S. equities and had been overweight equities really for the lion's share of this year. In late June this year, we started to take that position down, and we're back down to neutral, in part because we think the markets are at a deadlock. Deadlock because bond yields are really at multi-decade highs, highest level we've seen in the past 15 years, and equities are feeling the heat of it.
You're being too humble. You killed it. More than any other institution, Voya absolutely killed to shut up and buy America and buy blue chip. You absolutely killed it. Now, within the framework of amending and adjusting, because you had to justify your existence, I get that. But are you doing it within a bull market where you're looking for a second leg of a bull market, or is your neutral OMG, Mike Wilson could be right at Morgan Stanley?
No, we are definitely the first, right? So we think that this is still a continued up leg in a bull market. We think it's taking a breather. We think that bond yields are being pinned because the Fed is talking tough at this point, and the market realizes that. But we do think inflation is rolling over. We think that there are lead indicators that show us that wages are rolling over as well. And those things should be able to alleviate some of the higher for longer, and the Fed should be able to be cutting rates sometime in 2024. The market's going to feel that out, and when it does, we think equities are going to rip again.
How exactly are you going neutral, right? I mean, what are you selling and what are you buying in order to readjust?
So as our positions were kind of getting more and more overweight, we started continuing to selling down our international position, bringing it back into U.S. fixed income. We think that the bond yields that we are being offered at this point are very attractive. We bought some high yield. Yields are currently at 9%. That is a very attractive real yield. We don't think that the market's necessarily picked it up. A lot of people are really focusing on going into cash at this point. Money market funds have gotten over $1 trillion this year. And we think that the big buy really is buying bonds at the expense of equities. But we think that once bond yields have peaked, which we think we're getting closer, the more inflation data that we get, it should be able to start peaking out, and that'll be a big relief for equities.
There's been a lot of data that's come out surprising to the upside, including home prices, including jobless claims to, a positive downside surprise. Yeah. These metrics that are pointing to inflation having a risk of surging back up, which is what we're hearing from Fed officials. Aside from job earning, what would make you nervous that you have underestimated the inflationary pressure?
Look, the thing that we're thinking about for inflation so clearly is the owner's equivalent rent, right? All of our lead indicators on rent are rolling over, and are rolling over significantly and meaningfully. If there was an upside surprise, it would probably be to the wage data more so than anything else. The Fed has their eye on that at this point. But we do think that there's a lot of indicators that are pointing to inflation continuing to come down in a meaningful way.
John, I just want to emphasize here, you heard the language from Ms. Reinhardt. Rip again. Equities will rip again. That's CFA level 4, just so you understand that.
Let me lean on a question that we've asked already this week. I'll ask it of you.
Yes.
$95 crude. $95 crude. Does that give you more confidence to buy energy or more confidence to sell discretionary?
I would say it's a pinch at the pump. Right now you're seeing $7 gasoline prices in California. You're seeing $5.50 here in New York. It is definitely a tax on the consumer. If anything, it makes me think that probably a little bit away from discretionary and more towards energy. But our models aren't telling us to buy energy at this point.
Discretionary's already been beaten up quite severely.
Yeah.
And if you go across discretionary on the S&P 500, it's such a broad complex of companies. Any companies, any sectors that you think we should pull back or lean into a little bit more than others?
Yeah, I mean, if I had to really probably buy anything at this point, I would probably stay away from that and really go more towards buying some of the beaten down technology stocks and also going towards consumer services or communication services, sorry.
Dan Ives was just on. You're better dressed. I mean, people are
Thank
still
you.
recovering from Dan Ives' wardrobe. But, outfit of the day for Dan Ives. Let's go with Apple with Dan Ives. Do you share that optimism? They've been beaten down, and you just buy them off a free cash flow analysis.
Look, I think your points on Apple were really well taken. They've got a lot of free cash flow operation, a lot of operational leverage. Remember, I am top-down global macro, so I'm not buying individual stocks, but I think the tech sector has taken a big beating at this point. And if I had to say the next leg of leadership, as bond yields start to roll, it would have to go to companies like that.
And the major thing here, John, is the margin misguess of the Apple gloom crew. They've just said margins at some point will give way. And they're popping a 30%, I think it's an EBITDA margin, 33%. And they've sustained that. So if you make single-digit growth, it's down the income statement. You continue to see free cash flow.
It's still a cash machine, without a doubt.
Yeah.
As a 28 forward multiple, Tom, there's got to be a question asked about that.
Yes.
Should you be trading at 28 times earnings if you're not developing growth in your core asset?
I'm more shocked by a Walmart multiple of 24-ish, I believe it is, which is not the cash machine that Apple is.
That's the question we've all asked when it comes to tech. All this multiple growth that we've seen so far through 2023. Now you've got this bond market move. Shouldn't that take down some of that valuation story?
Well, the thing is, it depends if companies have to roll over their debt, right? Companies that are generating big free cash flow, if they have their debt termed out, which likely their treasurer did in 2002, in 2008, in 2020, right? I mean, corporate CFOs have learned a lot of lessons over the past 20 years. A lot of debt has been termed out. If they don't have to refinance, that free cash flow is going to keep on coming through.
Barbara, thank you. Barbara Reinhardt there of Voya Investment Management. If you are just joining us, welcome to the program. Plenty to talk about in this market, cross-asset and worldwide. Briefly, $95 crude on WTI, then we pull back. In the FX market, the dollar at levels we haven't seen all year, going back to the back end of last year on the dollar index. On the euro, briefly, 104. Dollar yen getting closer to 150. That turns around a little bit. We pull back on crude by 0.2% at 93.45. On the euro at 105.40. If you are just tuning in, welcome to the program. Equity futures, totally unchanged. Coming up a little bit later, 7:45 Eastern Time, Congressman Brian Stile, the Republican from Wisconsin. Lisa, drumroll on your favorite story, shutdown politics in Washington. You
we
can't
all
wait,
love
I
it.
know.
Oh, my
I know.
goodness. Everyone's so excited. There is a real question here about how we get anything done in Washington and about the leadership, especially with the backdrop of this potentially causing some hiccups. We heard that from Neil Kashkari, that this could actually be the one threat to the softy, Goldilocks, fantastic landing that everyone is expecting.
He's from the lower right corner, I should say, of Wisconsin, between Chicago and Milwaukee. I wonder how the shutdown chat is playing in his district. I have no idea.
Do you think there is any chat about that?
That's the point.
Do you think
I think
constituents
you're right.
are on the phone saying,
they're just a
"Don't
bunch
shut
of
down the
buffoons, and they're
government"?
going to fix it next number of days. That's what they're going to do. They'll get it fixed.
I think there's probably a bigger discussion about what's going on in Michigan. And I think that probably is going to be a bigger part of the discussion, frankly, right now than the political circus down in Washington, D.C.
Latest from UAW, it's the repeat deadline.
Exactly.
Right, so it's midday Eastern Time, Friday, with a news conference, Facebook Live event at 10 a.m. on Friday. So, Tom, you don't make progress. They don't feel like you're coming to the table in quite the same way. They feel good about Ford, or at least better, relative to the other two.
Right, and then there was that whole thing about shutting down a plant, so maybe they're going to come out and be a little bit more aggressive. We don't know, but Ford is sort of the golden child right now for UAW.
They're happy with Ford, just relative to Stellantis and GM. That's the latest, Tom. AMH coming up a little bit later down in Washington, D.C. Looking forward to that conversation. Don't know.
I'm paying $5.83 premium for the Bentley. $5.83. It's on the edge of London.
This is gasoline.
It's on the edge of London. I can't put regular in it.
I loved Bramo last week, just straight up. I didn't have to request it. No one said anything.
Yeah.
Petrol.
Yeah.
petrol.
I told you, when I'm in London,
Watch it, you're negotiating a contract, you're all on picket lines and everything, but it doesn't make a damn bit of difference what you get, because in 2 years you're all going to be out of business. You're not getting anything. What they're doing to the auto industry in Michigan and throughout the country is absolutely horrible and ridiculous. I side with the auto workers of America and with those who want to make America great again, and I always will.
Former President Donald Trump skipping the Republican debates, instead addressing the striking auto workers in Michigan. He was the elephant in the room at the GOP debate yesterday evening, and TK, a struggle of those competing to take the top place going into the presidential campaigns of next year in 2024, really struggling to take this former president down.
On schedule as well, as we had a guy with a megaphone and one without a megaphone, and I guess that's the Michigan Ballet, but far more, as I mentioned in the last hour, particularly for our international audience, there's a select group of Trump legal matters to be collegial, and one of them hit abruptly late yesterday afternoon. And my amateur take, I'm no Noah Feldman on this, is it was a bombshell for him and his family in New York. And it wasn't about election this or the drama. It was about the family business in New York. I wonder if that was a distracted Donald Trump in Michigan yesterday.
And yet still, TK, you look at the polling. Take everybody on the stage yesterday evening, and based on a lot of polls, even those guys pulled all together, they don't have a bigger share, at least, than the man himself, the former president.
Right. And this is a reason why we heard from Craig Valliere that he was the big winner yesterday, because they weren't able to suck the oxygen out of his run, even though he was flouting traditions, norms, by not showing up yet again to the second debate.
Amazing to see. More on that in just a moment. Down in Washington, we'll catch up with Anne-Marie. Just to touch base with the price action. Equities totally unchanged on the S&P 500. Lots to talk about elsewhere. Crude briefly at 95, now back to 93.47. New cycle highs in the bond market. Yields up again. 3 basis points on a 10-year. Your new high for the post-pandemic cycle is 464.68. Tom, we're just a little south of that level at the moment.
Well, it's a bond yield, the markets, and the turmoil, and it's going to get to play into it. We've heard a number of guests today say maybe wage growth has eased up a little bit, and we'll see the union impact as we can. Right now joining us, our Bloomberg Washington correspondent, Anne-Marie Horton. Anne-Marie, I was hugely remiss yesterday in not mentioning your high-impact interview with Mr. Tuberville, a senator from Alabama. It lit up the Washington world. This guy appears to be against the military, against any norms of grace in Washington. Who is this guy, and why did you light up the Beltway media with this interview?
Well, this was an interview Joe Matthew and I conducted 2 evenings ago, and the background of this is that Senator Tommy Tuberville of Alabama has this blockade on military nominees, but they did file cloture and were able to get through 3 generals, the most important one being the Air Force general, who's now the chairman of the Joint Chiefs of Staff. And Joe asked him why he didn't vote for the chairman to become the chairman of Joint Chiefs of Staff. And he said, listen, I like CQ, as he's known, Charles Brown. I like this general, but he talked about a lot of things like race and wanting to talk about race in our military. And then he said, quote, we're looking for the best of the best to do whatever. We're not looking for different groups, social justice groups. We don't want to single-handedly destroy our military from within. Let me tell you something. Our military is not an equal opportunity employer.
Okay.
And this is obviously a grave concern for the fact that U.S. history shows that actually the U.S. military is an equal opportunity employer.
Okay.
Harry Truman in the late 1940s had an executive order to desegregate the military and talk about it being an equal opportunity employer. And just quickly, Tom, we did have a rebuttal moments later when South Carolina Congressman James Clyburn joined us, and he said Tommy Tuberville, he said he's never said this publicly at least, but he said he is the worst of the worst, and people of Alabama ought to be ashamed of their senator.
One more question on this, because I know we got a lot of other news flow going on. Anne-Marie Horton, this is a football coach from Auburn University, period. He's an ESPN color analyst. Where in God's name is a senator from Kentucky?
Oh, well, when it comes to Senator Mitch McConnell, I mean, Senator Mitch McConnell clearly, I think, would like to get these nominees through. The issue is, Tom, in the Senate, one single individual can uphold votes. This is how the Senate works. All of a sudden, people become kings, not even presidents, kings.
It just
There is a way, though, that these nominees can get forward.
Right.
The issue is you'd have to file cloture and vote on each single nominee.
Okay.
And if you look at a recent memo from Congress, that would take 700 hours, meaning because there's more than 300 nominees,
right.
Meaning they need to work 24/7 for more than a month. Do you see that Senate doing that?
It
And
sounds
Tommy
like-
Tuberville
okay.
continues to say that there is not a readiness impact. But the individuals I talk to at the DOD and the foreign policy world say the issue is not readiness at this moment. But what are you sending a message to the downstream, to individuals who are up and coming, to attract the best talent, who can potentially go work in the private sector, who can go work for the defense, to the defense apparatus, Lockheed Martin, et cetera? What you're saying to them is maybe it's time to get out because the political nature of what's happening in Washington is just toxic.
Right now, Anne-Marie, a lot of the focus is just more on the industrial complex, on the former President Trump, who was in Michigan overnight. What has been the reception just generally with workers in that region who are non-unionized versus unionized? Did it matter that he was catering to non-union workers after the union kind of spurned him and didn't really invite him to the picket line?
Oh, they did not invite him to the picket line. They also were questioning why he showed up. When you look at what Sean Fain has said about the former president, Sean Fain has come out and said, we're striking against the billionaire class that former President Donald Trump represents. So Sean Fain was not going to come within an inch to a mile of the former president, which is why he was at a non-union plant. But what Trump is trying to get to the heart to here is the rank and file, blue-collar, working-class Americans. We have to just remember how important Michigan is. Trump was able to flip Michigan in 2016. He won Michigan against former Senator, former Secretary of the State, Hillary Clinton, former presidential candidate of the Democratic Party by 10,704 votes. That is not a lot of votes. If individuals voted for the Green Party, instead of the Green Party and voted for her, she would have won Michigan. But then obviously Biden picked up Michigan in 2020. Trump is just trying to strike a chord with these individuals, and he's also blaming the Biden administration for this strike, and he's talking about what he calls an EV glut that this administration is federally funding, and he's trying to really fearmonger these workers that they will no longer have a job because of the electrification of the grid.
5-minute plus conversation on politics in Washington. Didn't mention the debates overnight. Anne-Marie, what does that tell you?
I know. Well, it just feels like there was really not a lot of movement on the debate. It was underwhelming in the sense that no one really broke out yet again last night. When you had these seven candidates on stage, there's a lot to dissect with what happened last night. You did see more sharp elbows, especially from Senator Tim Scott. It seemed like he really showed up last night and had something to say with a voice. And you did see Chris Christie go after former President Donald Trump. We knew that was going to happen, but also Ron DeSantis going after him, saying he's missing in action. Why is he not here? So you are seeing these candidates finally start to attack the front runner that they are all running against to get that nominee, and that's the former president.
Where on the calendar, Anne-Marie, are people saying, you know what, we need to figure this out by then? That group that was on the stage last night needs to cut it down to one by X date. What is that X date?
I think it has to be by January, right, before we start to really get into these caucuses. But I would also say we need to remember there is a very important election coming up, a state election very close to where I'm sitting right now in Virginia. And there are still lots of whispers that Governor Glenn Youngkin, depending on how good of a night he has, and potentially flipping Virginia red, he's putting a ton of time and effort into these seats in Virginia in this off-season election, their local elections. If he has a good night, there is that potential that he could jump in. And that's really the dark horse candidate.
MH, thank you. Looking forward to Balance of Power a little bit later, 5 p.m. Eastern Time, with Joe Matthew and Katie Lyons contributing. Just got a nice email from Torsten Slok over at Apollo. We get tons of questions on the bond market. The question you get at the moment is why? Why yields higher? Here are 6 reasons. Sovereign downgrade, Japan exiting YCC, yield curve control, Fed QT, fewer dollars for China to recycle in a falling exports environment, the US budget, the large stock of T-bills and the Treasury's intention to increase auction sizes. Take your pick from those 6. Amanda Lynham of BlackRock, up next. If I told you where the bond market was this morning, you probably wouldn't have guessed that the equity market looked like this.
That is true.
Snoozy, unchanged. Equity's going absolutely nowhere. On the S&P 500, down about 0.2%. On the Nasdaq, if I showed you that, you probably wouldn't guess what's happening here. In the bond market, the 10-year, the 30-year, the 10-year this morning, having a little look at 465. Tom, yields up by 4 basis points. The 30-year is at 475 right now.
It's going to be a theme for us here. Global Wall Street, stay with us. The 10-year real yield, I'm going to go to 4 digits, John, 2.2971. Never for one breath in 2023 did I think that would happen.
Lisa, the whole curve just
breath.
shifting high this morning. 2s all the way out to 30s.
Do you think that Torsten Slot kind of reignited this from Apollo, basically coming out and saying, you want a list of reasons? Here's a list of reasons.
Take your pick.
Take your pick and try to go against that. There was a story this morning that I thought was interesting about T. Rowe Price outright shorting treasuries, particularly 10-year and 30-year treasuries, seeing that the yields could go even higher. And at what point, and I think we've been asking this, grappling with this, demanding our guests to answer this, at what point does this disrupt the risk trade that seems to be at least stable, if not necessarily rip-roaring this morning?
Starting in stocks, I think I keep going back to the same framing question, a reflection of the resilience or a source of instability. And based on maybe what we're seeing in consumer discretionary in the equity market more recently, you're starting to lean towards the latter and away from the former a little bit more.
It feels like a transition moment right now. It's a messy moment to extrapolate out in some kind of trend line because people do talk about the granular changes. And I see it anecdotally. I mean, I hear about it. I see it physically in my own life, the things that you choose or not choose because
like
things are getting more expensive.
Like
ski
that.
trips,
Sure.
like eating out, or eating in.
Isn't the Fed just extrapolating out current conditions through next year?
Yeah, I mean, that was sort of their Goldilocks projections that weren't their base case scenario.
But they are their forecast.
But they are.
Okay.
Exactly.
Good. I'm pleased we're still no clearer on that one a week or so later. Looking outside of the bond market, foreign exchange, dollar index, strongest point of the year so far. In the last 24 hours, the euro 104, back to 105.41 right now. Dollar yen really close to 150 at 149.33. Higher the session 149.63. And Tom, the question that you've been asking, I think is the right one to ask. At what point does the BOJ wake up in the morning and just say, yeah, enough of that, we're done?
Don't listen to me, listen to Stephen Englander, and he refused to draw the line on it, line in the sand, line in the whatever. The answer is we don't know. What I'll state categorically is the research shows second, third, fourth interventions have less impact. They're going to have to spend more ammo here if they choose to act at whatever level of weekend.
The dollar dominance over the last few months, this morning on the session at least, just a little bit of weakness out there in G10. Other surveillance this morning, no clear winners from the second Republican presidential debate last night. The 7 candidates sparring over the economy, immigration, tensions with China and funding for Ukraine. Shots were taken at President Biden and former President Donald Trump, who have been focused on the UAW strike. Trump skipped the debate to speak at a Detroit auto parts factory. TK has one favourite moment in all the debates, Bramo. It's put your hand up. It's put your hand up if you agree with.
Where did this come
Didn't
from?
Governor DeSantis say at the last debate that we're not children, we're not doing this? Did they do it again?
I don't know if they did it again because I didn't watch it. I let Anne-Marie Horton watch it and report to me on it. But where is any substance? I can't. How do you say it? Substantive. I'm never going to debate.
I'm not helping you.
Come on, help me here.
Hands up if we should go to the next story. Yes.
This makes Nixon Kennedy look like poetry.
Another threat coming from the UAW. Union President Shawn Fain saying more workers will walk off the job if major progress is not made. Fain's going to hold another Facebook Live event tomorrow at 10 a.m.
Oh, I didn't know that. Yeah.
I did say it earlier, TK.
I missed it. I was checking.
Fight over pensions,
Padres baseball,
retirement plans. I have no doubt about that. Reportedly, the latest sticking point between Labour and the Big Three. And we talked about the Big Three, Lisa, and maybe Ford. Ford is maybe the special child right now, doing a little bit better than the other two.
So Ford is the special child. However, they have come under the ire of potentially closing an EV battery manufacturing company that came under fire for some of its Chinese investments. There are questions around that. Key question to me is, how much ammunition does the UAW have to continue these strikes, to continue paying workers who are out of work? And also, what are they looking for? What is the end point? And how much has it been turbocharged by President Biden?
Where are we on 32 hours? Does that come up at all?
Not sure, but the president basically endorsed the 40% ask, the 40% pay raise ask, which is interesting, Bramo.
Even though they went down to 36% previously.
What is it now, 36 or 40?
Well,
because they came
36.
in going into the strikes, and is it 40 again?
Well, that's the question. Did President Biden bring it back up to 40%? Either way, this is the point. At what point is that really the tipping issue, or is it really something more substantive akin to the artificial intelligence of Hollywood?
I've got to squeeze this in. Some owners of the iPhone 15 Pro and Pro Max complaining the devices are getting too hot during use and charging. Apple technical support saying devices can get warm while gaming, streaming, high-quality video, or setting up your device for the first time. Experts pointing to the power used by the new A17 chip and the titanium case as possible explanations. Dan Ives of Wedbush with us in the previous hour saying, Tom, you can get this fixed in one software update and everyone can move on.
Yeah, it's happened before. Mark Gurman's the expert on this. I'm going to defer to Mr. Gurman, but the first thing I thought of is I'm certain there's been warm and hot issues before, and Ives is the expert. He says they fix it in software.
Are you getting this?
I don't know yet. Actually, I thought I was certain to get it, and now I'm not so sure.
Okay. What changed your mind? The heat, the titanium?
No. It's like, okay, I can take a break.
I don't need one.
Go out a year, go out 2
I'm done.
years, whatever.
Unless they break it with that software update that they force down our throats too, Bramo.
There's your summary here through the day. Right now, without question for Global Wall Street, our interview of the day on bonds, notes, and bills. Alana Naima has parchments in the usual accounting economics from Villanova, macro credit research at BlackRock, with a tour of duty at Goldman Sachs and other places along the winding road. She joins us. What's the level of sweat at BlackRock? I mean, are you all the windows locked and you're policing Kosterich and the rest of them to be sure they're okay?
No, I think we're all we're navigating, and good morning, and thank you for having me. I think we're all navigating what is a very dynamic market that is keeping us on our toes for sure. I think for corporate credit investors, what we've really been focused on is this higher cost of capital environment, and we're seeing it day by day kind of flow through the corporate credit market. And really for corporate credit fixed rate investors, the headwind has been on the risk-free rate. We haven't seen much repricing in credit spreads, and I think that's been a really notable feature of the third quarter, and that's probably something that will continue into the fourth quarter.
It's still happening, just a little bit, just incrementally. We're getting that spread widening. When you look within high yield at the moment, where do you see the greater pain being inflicted?
So we're seeing a really surprising dynamic, actually, where high quality is lagging and the lower quality, really, parts of the market are leading. And so if you just take the three broad buckets of leverage loans, high yield bonds, and investment grade bonds, arguably leverage loans are in the weakest vulnerable fundamental position because they've been contending with this higher borrowing costs for the past several quarters, really since early 2022. But they've had the best performance year to date. We don't think that that is sustainable over the long term. As you know, we don't view fixed rate corporate credit as immune from these headwinds either. So I do think that there will be some more differentiation. But I think going forward, what we've characterized it in our fourth quarter outlook is it's going to be about dispersion as opposed to widespread market disruption. And so when we're dealing with potential, headwinds to margins, wages, commodity costs, potentially slowing economic growth, higher borrowing costs, we think that that will really result in differentiation across the spectrum as opposed to kind of this rising tide lifts all boats macro.
I want to go to the question that John asked Ian Shepherdson. At what point will we feel the rates that the Fed has inflicted on the market and that we're seeing priced into the risk-free rate? When do we see that wave of refinancing where companies actually start paying 9% rates as opposed to the 3% rates they locked in a couple of years ago?
Right. So we're seeing it in the leverage loan market already. For the fixed rate borrowers, we're starting to see that come through, but frankly, I've been pleasantly surprised about the high yield market's ability to absorb the wave of September issuance that we've had come through the high yield market already. So we do think that that will continue. That maturity wall 2025 through 2029 will need to be addressed, but we think that that will continue.
I really am curious, though, about where this money is coming from, right? Is this coming from another pool like Treasuries, or is this coming from stock investors?
Yeah, so we've done some surveys as a firm across institutional investors, and there is a growing interest to deploy capital into fixed income, largely due to the repricing and all-in yields that we've seen over the past few quarters. I would say we're also seeing increased interest in areas like private credit as well. So I do think there was a decent amount of cash on the sidelines for investors to kind of play in the new issue market. In many instances, these are credits that these investors know well. And so if they're seeing them come through the primary market at a discount or on sale, that can be an attractive opportunity to deploy capital if it's a credit that you know well, you're comfortable with the risk, and more importantly, I think you're comfortable with the forward and that company's ability to navigate through this higher cost of capital environment. But as we've discussed previously, there will be winners and losers in this, and we're already seeing that in terms of defaults. I think the issue is if you have a capital structure that is over leveraged and perhaps formed in a low rate environment of 2021, even early 2022, those need to be right sized. And so there will be some real differentiation there.
I think your note was dead on about cost of capital, and my monitor of that is the 10-year real yield. There can be 47 other tea leaves to look at as well. So if I look at an elevated, shocking real rate where we are, I intuitively understand tangible assets like real estate are affected immediately. How does this new sustained real rate affect fungible assets like bonds, notes, and bills?
I think one of the key takeaways that we're expecting is that the bar for transactions is probably going to be higher. So if you're a corporate and you are thinking of doing an M&A transaction, the higher real rate may make you say, this is not as an attractive opportunity given when my financing was much cheaper. Going forward for real estate, and even I think for private equity and sponsor-related transactions, we need increased clarity on the macro. We don't necessarily need a good macro. And so for corporates that are thinking of transacting, I think if we can get comfortable that we're at the end of the policy cycle, that will give them some clarity to move forward. To your point, though, Tom, the higher cost of capital in general will probably skew those transactions towards the acquirers that don't need to rely on the aggressive funding to get them done. So these are cash-rich pharma, cash-rich tech, highly rated investment-grade companies with strong financing. I think you are going to see a mix shift in terms of the skewing of the financing activity that we see going forward.
If we can get comfortable, are you feeling comfortable?
I do think we were bracing for a higher for longer environment with a higher cost of capital, but the repricing that we've seen has been so swift that it's hard to really feel comfortable that we're at the end of it. And so it's a really challenging dynamic backdrop to navigate for sure.
Amanda, every time I wrap up a conversation with you, it's a clinic. A clinic with Amanda Liner of BlackRock. Amanda, thank you. As always, thank you very much. If you're just joining the program, welcome. Let's check out the price action for you on the S&P 500. Equity futures turning a little bit lower with this move in the bond market. Yields up 4 basis points, 464.89 on stocks, negative here by 0.2%. I've just read the most amazing note from Steve Major of HSBC. Absolutely fascinating stuff. I think I've got maybe like 90 seconds to try and explain this. Why bonds are not potatoes.
Love this.
Okay, let me try and get into it. The intuitive view that supply means lower prices, high yields, misses prior conditions. Elasticity of demand and the simple fact that bonds are different from potatoes. In normal times, Tom, they're sophisticated financial products, easily exchanged for cash. And in fact, you might say, could make an argument, Tom, and he's alluding to this in this note, that the higher the debt, the lower the growth profile. He says this, though, these are not normal times. A key difference today compared with previous cycles is that we cannot assume that bonds roll down the curve, thereby gaining value through time. This only applies when the curve is upward sloping from left to right, which is not the case right now in Treasuries. And this is what he has to say on term premium, and I hope you're still with me. Rising term premium is occurring because investors are being asked to receive bonds for less yield than offered in the money markets, and at a time when budget deficits are increasing without a recession. That point at the end there, TK. Right. Really important.
And folds into the 5-6 reasons that Torsten Slok had for where we are right now. I can't say enough how there's a point in the Amanda Lynham space where we go from a convenient yield analysis where people go, what's the price of the bond? What's the price of the note and the bill? I don't think we're there yet, but we're getting there.
I think we're getting there. The long bond.
Yeah.
We talked about one of those 30-year issues from a couple of years ago.
But I'm talking
like
about
50 cents on the dollar.
I'm talking about the Anaconda Copper 12-year piece.
Gotcha.
I'm all yield. You know what? There's a point. Excuse me. Can we move this? What's the price?
Matt Lazzetti, Deutsche Bank, 8:30 Eastern Time. We'll catch up with him in about 45 minutes. From New York, this is Bloomberg.
I have a radical idea for the Republican Party. We need to win elections. And part of how we win elections is reaching the next generation of young Americans where they are.
This is infuriating because TikTok is one of the most dangerous social media apps that we could have. And what you've got, I honestly, every time I hear you, I feel a little bit dumber for what you say.
Just because Putin's an evil dictator does not mean that Ukraine is good. This is a country that has banned 11 opposition parties.
A win
that has
for
actually,
Russia is a
that
win
is not
for
true.
China.
We're driving
a win
Russia.
For Russia is a win for China.
Excuse me, if you'll have
but
a chance.
I forgot you like China. That's why you're over there.
Are they done yet? Nikki Haley, Vivek Ramaswamy sparring last night at the GOP debates. Just amazing to try and follow some of that, TK, on China, on TikTok, and Vivek's recent appearance on that particular app.
We are so damn lucky that bedtime is 6 p.m. I'm sorry.
Well, you skip this one.
You know, you're in your jammies at 5:30. You're trying to figure out if the first baseball game you can see one inning. John, I'm embarrassed as a citizen about that. It's just not good.
You see lots of that elsewhere. Isn't this what you'd expect in the primary season?
Not
Stuff like this?
Not in the old days. There was a decorum to it where now it's, I don't even know who to blame.
The impression that's lost. I sat down with Gordon Brown earlier this week, Tom, the former British Prime Minister.
Yes.
Just that decorum is gone. I don't know where that is anymore.
Yeah, I don't know. I really don't know what to say. Should we go to an expert on this?
Absolutely.
I think we should go to an expert on this. Lost between the potential of a Chicago Cubs-Milwaukee Brewers playoff is a gentleman caught in the middle. Brian Steele's in the lower right corner of Wisconsin to bring it out. He is the Republican from Wisconsin, and we join us today. Brian, we're talking here about Civics 101. How do you respond as a grizzled pro to a debate like that? A debate that just seems so juvenile.
I think we have to ask ourselves the question, at the end of the day, did viewers walk away informed about the most important policy issues of the day? I don't know that format's leading to that. We have so many serious challenges from the fiscal standpoint to foreign policy, and this seems to be a conversation that's built for Twitter clicks.
We've had a president and a former president enjoy the climes of Detroit. Wisconsin is sort of northwest Detroit, or maybe Detroit southeast Wisconsin. We'll let you decide that. Your thoughts on the political input of these two presidents into the UAW process?
Yeah, I was born and raised in Janesville, Wisconsin, where we had a UAW General Motors plant that would ultimately leave around 2010. And so I understand what these workers are feeling right now who are on the picket lines. Ultimately, workers across the country are feeling that their wages have not kept up with inflation, so they're fighting for more money. Politically, I think this is the right move to go and actually have the conversation with the men and women who are working day in and day out. And I think at the end of the day, the bread and butter issue, the fact that wages are well below inflation, the average family is spending over $700 a month more today than they were 2.5 years ago for the same things, ultimately will punish Democrats.
As we talk about wages, there's a question about whether 800,000 government workers will get paid come Monday, given the fact that there is likely to be a shutdown. Do you think it's appropriate for them to not get paid in order to have some of the political wrangling worked out?
There's absolutely nothing positive that comes out of a shutdown. It hurts the American people and the credibility of our government. We're working to hopefully avoid that. That's going to be a challenge, but hopefully cooler heads prevail here by Saturday night. There is nothing right with people, Americans, who are working, who are not getting paid for that work.
What people are saying is that it's very likely that there will be a shutdown, that there seems to be an impasse, and that Kevin McCarthy is sort of not doing his job very well as the leader of a very fractured group. Do you get the sense that he is frustrated, that he regrets taking this job?
I think we're all frustrated. I think he's done a pretty darn good job trying to wrangle everyone together to move us forward. The Senate also is in dire straits. They haven't moved their funding bills either. The entire system of spending in Washington is completely broken. It needs a complete rewrite. We're also here 48 hours away. What do? I think we really need to come together to pass a clean stopgap measure, keep funding and government moving forward while we work out the details of these important spending bills.
But, I want to just push back a little bit because, Congressman Style, you said that Senate has their own problems. Mitch McConnell actually is working together with the Democrats to try to come up with something. They are passing through certain measures. It's not just about this being both sides of the aisle. Is this a fundamentally problematic issue with the House? And really, it has nothing to do with the Senate. It really is a House issue led by some of the fractures in the Republican Party.
I'd offer to you that there's a few members on the Republican side in the House that probably get a lot more media attention. But I would note that as we actually look at the appropriations bills moving forward, the Senate is maybe further behind than the House. Neither are doing a good job. The underlying system here in which we're working on spending in D.C. completely broken.
Congressman, would Ronald Reagan recognize your party? It seems like the nation, we know this well, has moved conservative over the last 20, 30, dare I say 40 years as well. Where would Ronald Reagan fit into your modern GOP?
I think we're still a center-right country, and I think Ronald Reagan would be able to lead this well. I think the big distinction is many of our loudest policymakers are no longer speaking in the aspirational tones that Ronald Reagan did. If we returned as conservatives and talked about how we're going to produce opportunity, address the biggest challenges of the day. Why can't you do? I don't mean to interrupt, but because of time, Congressman, you nailed it. You absolutely nailed it. Why can't your GOP leadership insist on that aspirational tone? The broader media environment, Twitter and others, seem to like the confrontation. As we saw on the debate stage last night, there aren't enough programs like yours that have substantive and serious conversations about the policy issues of the day.
Okay, but you got a guy in New York City, Mr. Trump, who invented a GOP of grievance. It's a grievance party, which is anathema to Janesville, Wisconsin. How do you go from a grievance GOP, not back to, but towards something new that is that aspiration of the GOP back to 1860?
Well, I can tell you when I'm at home in Wisconsin, which founded the Republican Party in Ripon, Wisconsin, people are still optimistic, believe our best days are ahead, recognize we have serious and substantive challenges, and what I think we need is a leader of the party that talks about how we are going to move forward in a difficult period of time.
Congressman, thank you. We're going to clip some of that and put it in promos. Congressman Brian Style there. Thank you very much, sir, for joining us on the latest as the clock is ticking towards the potential shutdown later on this week, TK. Getting closer and closer to that deadline.
That was brilliant. That's a guy who's doing GOP 101, whether you agree with him or not. It's the view. We get on a plane and we do flyby. Maybe we wander into O'Hare for 25 minutes. But basically, John, we're all guilty of missing Congressman Steele's country. And the bottom line is this party has shifted to a grievance structure dominated by a unique Southern cast. Witness Anne Marie and Joe Matthews' important interview with the senator from Alabama. And there's guys like Steele out there. They're not progressive. They're not Democrats, but their heads are spinning over what's become of their party.
It's not a flyover state. It is my mom's.
I thought you were about to say it's not Steele, it's Style.
It's Style. It is Style. It is Congressman Style. That as well. But I will say,
small detail.
My family's from Wisconsin, actually, and I will just say that that it has always been a hotbed of political thought in a lot of different ways.
Yes.
And there are many different sections, whether it's Madison or whether it's Appleton, and there's a real question here about which path is going to win out. It is one of the 8 states that will determine this election. And it raises this question, how do you get to candidates that can appeal in this sort of bifurcated, very specific type of culture in each state? I don't know the answer to it, but we are looking at some real issues that are kind of getting bifurcated off in favor of some other
But you nailed there the Wisconsin of 50, 70, 80 years ago, where there was a raging debate, an intelligent civil debate where people could agree to disagree. Now it's just TV moments where a guy like Congressman Style, I got it right that time, Congressman Style of Wisconsin, where he seems almost removed, John, he seems almost removed from the debate.
You should just get Bramo to fill in the sentences for you, T.
Yeah, it's good.
That's the way forward.
And then to say I did great.
I was just corresponding with Steve Major's team over at HSBC, October 16th. So we'll catch up with him in a couple of Mondays' times on this bond market. After some big moves, Monica DeCenso of JP Morgan is going to be joining us shortly, just to bring you a snapshot of some of the price action right now, this Thursday morning. Equities on the S&P 500 turning a little bit lower, down by about 0.1%. Dollar showing a little bit of weakness after really dominating and showing some strength recently. 105.44 on the euro against the dollar. And in the bond market, new cycle highs in the bond market. Yields up by 3 basis points. Just below session highs, we're at 4.64 on a US 10-year. Crude had a little look at 95. It's back down to about 93. From New York City this morning, good morning.
We think that inflation is going to continue to remain on this downward trend.
The market all year has told us that it's not convinced we've seen the worst part of the business cycle.
The world isn't growing nearly as fast as we expected.
The consumer's already stretched here. They're trying to maintain their level of spending.
That's where the risk becomes of a 2024 recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, Bond Central. Thank you so much for joining on radio and television. Where will we be at 2 p.m. when the equity market explodes up on a short sleeve? Unchanged in the equity markets. John, the news is bonds and FX. Everyone adjusts.
I can't tell you where we'll be. I can tell you where we are. We just had, Tom, a cycle high on a 10-year, 465. We're back down to about 463. But the story of the last few weeks, the last few months for that matter, is yields up. And off the back of that, it's dollar stronger. The dollar index at the highs of the year in the last 24 hours. Euro dollar had a sneak peek of 104. 150 was in sight on dollar yen. For a heartbeat, Tom, we backed away. But certainly stronger dollar, high yields, energy market rally, equities dazed and confused.
Brent crude 96. We saw 97 there. Shocking. Saudi light. Javier Blas watches at $102 a barrel. Moments ago, the kind of headline any and all need, including Jerome Powell. John, Germany harmonized CPI. They speak in harmony when they look at that. It's before the Oktoberfest CPI. CPI rises 4.3%. The estimate was a higher statistic, 4.5%. Those are the disinflationary tea leaves that are salvation for all.
That's a big downside surprise on CPI in Germany. We were looking for a move lower from 6.4 to 4.5. We go even lower than that at 4.3 year over year, month over month. 0.2. Do a lot of the year-over-year stuff in Europe, and someone came on a program recently and made that point, Bramo. Look at month-over-month at the moment. We're in a better place in Europe, but crude's not in a better place for Europe. The euro is not in a better place for Europe. The growth profile is not in a better place for Europe. The CCB faces a really tough task to get inflation down without causing even more damage, Lisa, than they've already done.
Especially because Europe is not like the U.S. in that there are lots of different economies, and we saw that from Spain with inflation unexpectedly accelerating overnight. So yes, Germany is seeing that disinflation. It isn't a uniform story all across the region at a time where it still is too hot. And year over year, it looks unsustainable for a region that was, seeing no inflation.
But we saw in equities yesterday the percolation of a short squeeze. It popped. John, you mentioned this at the top of the show this morning. Equities popped 2 p.m., 3 p.m. Yesterday. Red and green on the screen today. But the focus, you got to micro-analyze the bond space. And to me, dovetailed with FX, what's different, euro, weaker, yen, stable. These are little tea leaves you got to look at in this milieu.
I think the beauty, Tom, of the next couple of weeks is we can get away from hopes and dreams and forecast projections, all of that stuff. We can look at data again. Claims this morning, a little bit later this morning, still in and around 200K. Let's see if they climb, at all, and what they climb to. That's going to come a little bit later. Then it's on to payrolls next week, and then it's earnings season, middle of October. The banks begin to deliver.
October 13th,
JP Morgan.
We did that when you were on sabbatical there. John, we got to stop the show here. We are 27 minutes away from not a normal GDP report. Michael McKee will be expert on this. But, John, this is GDP, which is what we know, GDI, which is what we flunked freshman year in economics, and they're dovetailing wrapped around what is the Fed doing in a higher interest rate milieu. What's important here is with the revisions that go back to when Jefferson was president, we're going to have a whole movable feast at 8:30 today.
Bramo, do I care about the revisions at 8:30?
If they are revised to the upside, then it feeds into the fears that people have of too good data, that the economy is accelerating. I love how you say we can get away from the hopes and dreams. This market is getting exhausting because it's so hard to understand what's underpinning the move higher. People are trying to explain it, but at this point, it feels like a self-perpetuating kind of thing that goes beyond the data, the discussions, the anything, to just momentum.
Self-perpetuate this. My data check. Bank rate, 30-year mortgage, over 7.8%. John, a new level there of a higher mortgage rate, nudging towards 8%.
And to be clear, Tom, the move we've seen in the bond market in treasuries, the bulk of it has been at the long end. The 2 years been pinned.
Yes.
North of 5%, in and around 5.1. Yes. And if you were looking for steepness, Tom, you wouldn't have looked for that kind of steepener. You would have looked for a bull steepener because we thought the Fed would be cutting interest rates.
Right.
We thought we'd be in recession by the end of 2023, and that's not where we are. So to see the 10-year move by as much as it has, the 30-year move by as much as it has, and linked to a range of stories, not just the economic data. As Torsten Slok of Apollo put it, yield curve control, Japan. Look at a 10-year benchmark over there, 75 basis points. Unthinkable 12 months ago.
And I'm going to bring it to the
Treasury refunding. Take your pick.
The nominal dynamics. I'm going to go to Amanda Lyon, and she's dead on. It's cost to capital with a 10-year real yield, 2.27%. That was unimaginable even 5 days ago.
I've got a great guest, Tom, so I'm going to whip through the price action just briefly. Equities going into the opening bell, 1 hour and about 30 minutes away. Slightly positive by not even 0.1%. Yields a little bit higher. Cycle highs a little bit earlier on a 10-year intraday, 465. Just backing away a bit, up by a basis point now, Tom. Let's call it 462.
With a clarity of note forward, what a joy to read from JP Morgan Private Bank. We believe, Monica DeCenzo with us right now, head of Global Investment Opportunities, JP Morgan Private Bank. I love buried in your note. You just frame it out old school. You got a base case, middle of 2024, up 14%. No one believes you this morning. How do you get there?
It is based on our view that while I think there's still challenges ahead, we have seen a lot of sectors, a lot of companies already move through an earnings recession. And when you apply a similar multiple to where we are now to the forward earnings that we expect, that's how we get there. Now, I don't want to pretend there's no risk here, because there is. And what we've seen in the last few days has been choppy, has been challenging. People are definitely nervous. What I think is interesting about that call is on the bear case, we're looking for maybe 5, 6, 7% downside. There's significantly more upside. That's the kind of skew and risk reward that I find interesting when you look at equities here.
Can you
Again, out a year
identify?
though, next few weeks, anybody's guess as we head into earnings, because there's going to be a lot of data coming out.
Before you make the equity call, can you actually identify what's driving the bond market? To see this move in the long end has been phenomenal. Not just treasuries, but gilts this morning in the UK. 10-year gilt yield is up by 14 basis points. What's going on here?
It's very hard, in my opinion, to understand this. What I will tell you, when I look at what our clients are doing and how they're positioning, we had a lot of people who had bets on that they thought rates would go higher than expected into year end. They're starting to take gains on those positions and take those positions off. So I'm seeing people start to assume this cools. Now, we'll see if they're right or not. What's interesting, in addition to those rate bets, they also had equity hedges on. I haven't seen people take off the equity hedges. They're still worried about a lag effect from what the Fed has done near term to equities. So the positioning that I'm seeing still a little bearish on equities as we move into year end, and people betting that maybe rates have moved far enough for the near term.
When something happens in markets, everyone just blames risk parity funds and hedge funds.
Yeah.
Is there any evidence? It's easy, and it seems like, oh, well, there were some warnings from different politicians that potentially that could cause the unraveling of the Treasury market. Yeah. How much is that behind things?
Right now, it feels like a lot of it, because when I look at where our portfolios are positioned, where clients are positioned, they're still sitting in a ton of cash. So I'm not seeing people moving in and out of the market with that sort of velocity. It tells you someone else is. And so that feeds that argument that it's those funds that might be moving things in a time, again, where there's not a lot of data, not a lot of news. And so you have these swings can kind of be amplified a bit.
Do you think that equities are realizing or saying that the bond market has any validity whatsoever right now, right? I mean, does it cohere to you that we are seeing stasis in stocks, even as bonds go haywire?
Someone will be right, and I think the bond guys will tell you it's them. Equities tend to be a little more optimistic in my side of the world. But listen, I think back to where we started the year. Everyone was very bearish. They were wrong. The market actually rallied. You can argue it wasn't a widespread rally, but it was still a rally. And if you own the S&P, you were happy. Fast forward to the summer, everyone was probably too bullish. So now we're coming down a bit to a more of a normalized state. What I struggle with, and clients I work with struggle with, is what do? You want to stay invested. You don't want to sit in cash. And I loved Mike Wilson's comments earlier in the week. Even though you can have a bearish view, that doesn't mean you sit in cash. You tweak your exposure. You think about balancing risk in a more thoughtful way. And equities were the only game in town for a long time, and people need to start having more balance.
He talked about late cycle winners, sectors, and he mentioned energy. Is that something you like based on what we're seeing in crude at the moment?
I know Christian was on earlier in the week. I'll leave him to predict where crude's going to go. But we talked a lot internally about, does $100 a barrel, can that sustain here? Is it a different market than it was 10 years ago? I think there's a very good case for that. And then if you can sustain here, or let's say even have a bearish level of 60, 70, that is a case for energy equities. I do think these companies are different than they were 10 years ago, just like the oil market is different. Many of them have found a bit of religion. They're managing capital a bit better. And so there are pockets there that you could invest in. A few years ago, everyone thought energy's over. It's all about ESG. I think both things can be true. You can have investments in ESG, but you still need oil near term. And some of these companies are in a much better position, especially if oil can hang out anywhere near 95.
Is there a preference for US-based energy companies versus, say, Europe?
I actually think some of the European ones are interesting following the move on the euro, and they do return a fair amount of capital. And you also have companies that, if you look at the European market, many funds over there have not been investing into energy for a lot of reasons. Some of them are not allowed to. And so that creates a bit of a dislocation, and you have a valuation gap that looks pretty attractive in Europe on energy.
One of the important things of JP Morgan Private Bank is listening to clients. What are your clients saying about the efficacy of cash? You mentioned this in your research note. And in the trauma that we're in right now, it's a really important time to listen to what people are fearful of. What are they afraid of?
Everyone anchors to the volatility and the recessions we last lived through. COVID, which was a shock for people, in 2008, which was really severe and maybe not representative of what this next cycle will end like. And so that's the fear. People say, you know what, I don't want to feel that again. I want to sit in cash. Cash feels good. The problem is, even if you're making 5% plus, when there's inflation, what is your real return on that cash? It's not as interesting as they might think. And so the big risk to me is people just sit in cash and you miss the end of the cycle and the beginning of the next, because it's not going to feel good. The market's going to look ahead and move before things feel good. And so the biggest conversation I have is just, again, stay invested, but tweak. There are ways to get balance without being in cash. You can look at investment grade, other parts of the fixed income market to maybe earn you a little more.
Can I get you in trouble with the rest of the JP Morgan Combine?
We're all friends.
You were legendary in entertainment securities analysis. What in God's name does Disney do? I don't want to get you in trouble, but everyone wants to know what Monica DeCenzo says about Disney.
Thank you. I don't speak to specific stocks anymore. I'm in a different role now, but
no one's listening or watching, so please.
Exactly.
What do you think of Disney?
Just us girls here, it's a fascinating story to watch, and I believe in the power of strong brands, and there is no brand, in my opinion, like Disney around the world, and so I'm excited to watch where this goes. It's tough to watch the turmoil. Obviously, the writer's strike and all that is starting to move behind us, hopefully. I think there's a lot of levers there. They have amazing content, amazing parks, amazing brand. It's just figuring out how to get that all in place.
Okay, you can ignore that JP Morgan General Counsel. That was just, we'll take that out of the tape. Monica,
down with that, beautiful.
Thank you.
Monica DeCenzo of JP Morgan Private Bank. Monica, thank you. Good to see you, as always. If you're just tuning in, welcome to the program. Your equity market on the S&P 500, just about positive here by 0.08%. Coming up in about 18 minutes from now, Matt Lazzetti, Deutsche Bank, reacting to a slew of US economic data, jobless claims, GDP revisions. Look out for all of that. We mentioned the energy sector. Bramo yesterday, Exxon at the close, all-time highs at the close yesterday.
There seems to be a feel that oil prices could go substantially higher. And it's not just because of the supply-demand dynamic, but it's because it hasn't really adjusted to inflation. And I think that's suddenly coming close, that $100 today is not the same as $100 10 years ago.
I'm fascinated by that. I think you're correct, but I really wonder what $105 or $110 is like if they manage it out farther. I should be in the timeout chair. That was most unfair of me to have Monica DeCenzo comment on Disney.
Are you going to apologize?
But I'm not going to apologize.
No, he's going to double down and ask for more.
I have a huge bias to blended strategists who are in the trenches of individual stock securities analysis. They've been, with their accounting work at Pricewaterhouse. It was, I can't remember which eight, Price, Cooper's Light Brand, one of those, it was
PwC?
PwC, well, it was before that, Ernst & Winnie, who knows. But the answer is legit auditing, legit security analysis. You go with a humility into the parlor game of guessing where we're going to be in 6 months.
September, energy up by more than 4%. Consumer discretionary down by 7.
Yeah, you're on that. Well done.
Year to date, so far year to date, consumer discretionary still up by more than 20%. It's been the place to be. Certainly not this month, but for the year. And we'll see if that changes going to year end, given the headwinds that everyone's talking about for the US consumer. Henrietta Trey's of Vader Partners, charged with explaining what on earth is going on in Congress. That's next.
I have a radical idea for the Republican Party. We need to win elections. And part of how we win elections is reaching the next generation of young Americans where they are.
This is infuriating because TikTok is one of the most dangerous social media apps that we could have. And what you've got, I honestly, every time I hear you, I feel a little bit dumber for what you say.
Just because Putin is not Putin's an evil dictator does not mean that Ukraine is good. This is a country that has banned 11 opposition parties.
A win
that has
for
actually,
Russia is a
that
win
is not
for
true.
China.
We're driving
a win
Russia.
For Russia is a win for China.
Excuse me, if you have
but
a chance,
I forgot you like China. That's why you'll
have.
Nikki Haley, Vivek Ramaswamy, sparring last night at the GOP debates. Round 2 took place in the last 24 hours. We'll pick up on that in just a moment. If you are just joining us, lots of data in a little over 10 minutes. 10 minutes around the corner, we're going to get jobless claims, some GDP revisions, a slew of US economic data. Going into it, equities are doing okay on the S&P 500, positive by 0.6%, 0.06% to be precise. In the bond market, yields are a little bit higher by a couple of basis points, 462 on a 10-year, stateside in the Treasury market. Earlier on today, 465. But look over to Europe and what's taking place. Germany, even with a soft inflation print, the German 10-year Bund, that yield is up 8 basis points.
Wow.
In the UK,
well done.
It's up by more than 10. Wow. So you're starting to see these moves in Europe track these moves in the United States. Just a really soft backdrop, Tom, for sovereign bonds. Yields up, bonds down.
And that's the change. That brilliantly captures the angst out there about it slipping away. And, John, we saw that. I was in the surveillance nap yesterday, and you know what? It's just blunt. Forget about the equity short squeeze baloney. The fact is it slipped away yesterday. Are we going to see that again today off this 8:30 data in 12 minutes?
What's surprising is even with that soft print in Germany, Lisa, it's not lending itself to supporting this bond market in any way, looking at Germany and looking across Europe.
Which again goes to the fundamental question that we've been asking all morning and all week, which is what's driving this? Why are bond yields going so much higher on the long end? What is the durable aspect of this? And if you don't understand it and you're a stock investor, do you just say, I don't care?
I'm going to say uncertainty into what we're going to see at 8:30. Moments ago, you can see it on the Bloomberg terminal, 2.3028% on the real yield.
Are we restrictive yet?
We are restrictive based on the Bloomberg Financial Conditions Index. We've come from a accommodative 0.36 on standard deviation right down to 0. Raging debate, as Steve Rasciuto was brilliant yesterday said, we're restrictive in many ways.
This is the Bundesbank president speaking just moments ago. The base case is the hiking cycle could end with a soft landing. That's coming from the ECB, coming from the Bundesbank. Bramo, the base case is the hiking cycle could end with a soft landing. I'd need the context around this interview. I'd like to read the transcript for it before I offer too much judgment, but I'll give you a little. Soft landing in Europe, they've already had a big downturn.
That's basically what I said. How can you call a recession in Germany a soft landing? It's already a recession. So are we redefining what it means to have a soft landing?
Totally. Making it up as we go along, TK, as you've said a million times.
Well, we are, and we're going to have to follow this, and I really want you to stay with us, folks. Global Wall Street and radio and television. Mike McKee is going to be lights out here in 10 minutes on a key GDP report. Could be a snooze fest, but maybe not. Revisions back many, many years. I'm going to go back many, many years right now. I remember this. It was collegial of Tennessee, Lamar Alexander, Patrick Buchanan, fiery at the time, Bob Dornan of California, Forbes, Steve Forbes, editor of Forbes magazine. It was a debate at Arizona State in 1996, unlike what we saw last night. With perspective, Henrietta Trey's, Director of Economic Policy Research at Vader Partners, they analyzed GOP debates. How did we get here, Henrietta, in your study of our political science? How did we get from a collegial debate of Lamar Alexander and Steve Forbes to what we witnessed last night?
That is a fantastic question. I think the real problem is that you have a bunch of candidates who know that they have no chance to move ahead in the polls. I felt there was a lot of frustration in the debate last night. Members like Senator Tim Scott, who has should have enough facial recognition by now, was still trying to explain his life story, as we heard from a bunch of the others as well, DeSantis and Ramaswamy. Candidates are really just trying to tell voters who they are still. And altogether, if they combine forces into one big candidate, they'd still be at only 30% in the polls. So I think their frustration is that they can't break through the Trump cloud. And I think that's what's driving a lot of the incivility. And they definitely went off track last night.
Is the Trump cloud affecting the shutdown due this weekend?
Absolutely. When you look at the 45 members of the Freedom Caucus, 10 of whom are really driving this shutdown right now, the sense I get from staff on Capitol Hill and their view is that this is effectively McCarthy versus Trump. And McCarthy's going to lose that fight every single time. So Trump is basically saying, if you shut down the government, it's very akin to what he said during a debate or a town hall presentation he made during the debt ceiling debate. I'm not president now, so I don't care what you do. Shut the government down, default on our debt. And they're saying, all right, fine, we'll do that. And he conflates it with defunding the Department of Justice, which will end his 4 indictment proceedings. A lot of folks on the Hill believe that Donald Trump is the arbiter of whether or not the Freedom Caucus can vote to keep the government open. And if that's so, then they will never vote for a CR. They will never vote for an appropriations package, and they will never vote to keep the government open.
If that's the case, Henrietta, and the government does shut down, does the former president, Donald Trump, bear the blame in the public's eyes?
I don't think in the public's eyes. I think that's a little bit too nuanced to ask. The public disproportionately does blame Republicans, but Trump ranks third in polling on that. And just beneath that is everybody. You heard that from Chris Christie a lot last night, and I didn't think it was an unfair criticism. Everybody's to blame in this, but the Republicans, and in particular, McCarthy and his lack of ability to call a spade, recognize that you're never going to get the votes from those Freedom Caucus members and move forward in the way democracy is designed with a Democratic majority in the Senate and pass legislation that is your job. It is the job function at the basis level. And McCarthy is refusing to make that choice so far. I believe there's still a window of time for him to make that choice tonight, tomorrow, and Saturday. As you all know, 72 hours in D.C. is a lifetime, and that's what we're heading into. As one particularly eloquent client put it yesterday, we're at the crest of the wave right now, and I think that's accurate.
What do you think the chances, Henrietta, are of Kevin McCarthy being the House Speaker in a month?
I think they're high because I think the motion to vacate is bogus. I don't think that the Freedom Caucus has the votes to eject the Speaker, and I have constantly been in communication with Democratic staff who are more than willing to hold their nose and vote present or to table the motion, which will be in and of itself embarrassing to McCarthy. But the bottom line is the Freedom Caucus doesn't have enough votes to eject McCarthy. So I'd love to see them, as I said last time, I'd love to see the motion to vacate hit the floor and fail. And then we can maybe break the fever and move forward.
You know, what I think is really cool here, Henrietta, we always look at our guests, and we all know they're so smart, and we really look at the libraries. And, John, I just think when we got a guest styling the Beastie Boys in her library, I mean, we got to give her maximum credit. I mean, she's got the Ad Rock thing going right now, and she's got their wonderful new. It's an audiobook as well. But Henrietta's doing all Beastie Boys. I mean, we got to have her back.
Henrietta, you have the right to reply.
He was behind me.
Henrietta, thank you, as always. Henrietta Trace there of Vader Partners. Whenever she comes on, I always get great feedback about Henrietta. Always, the screen lights up. Get her on more. Coming up in the next hour on Bloomberg TV, David Leibovitz of JP Morgan, Joyce Bory of Allspring, and Sonal Desai of Franklin Templeton. Some real expertise there on the bond market, and this bond market going in the direction that Sonal was looking for, Tom, through much of this year. That's high yields. And when I ask her the question at about 9:30 Eastern time, are we restrictive? Take a listen to what she has to say on that, because it might not be what you think it's going to be.
This is fabulous. I can't wait to listen to what you do with George Bory, who's in the trenches of price down in the bond market.
Credit.
Yeah.
Whether things are getting to that point where...
Oh, no, we're there. Price down. We may, maybe all this Bloomberg surveillance yield analysis baloney. price down. That's what it is.
So I love our viewer comments, and a viewer writes in and says, what's driving bond yields? Because I've been asking it all morning.
Sure.
He said more sellers than buyers.
That's
and,
helpful.
You know, that, but
which goes to price.
You know, and then he said sometimes it really is that simple. Though this time around, it's probably more a buyer's strike than forced stop-outs or selling of duration.
It's hard to argue with some of that. At the corner of my eye, Mike McKee. Mike McKee's going to sit around this table in just a moment, about 5 minutes away.
He's wearing revision white.
Tons of economic data, including possible revisions to GDP, jobless claims as well. That's next from New York. This is Bloomberg.
Bloomberg Surveillance, John Ferro on assignment to get to 9 a.m. This morning on the Open. Some good guests there. George Borey will join him as well. We're going to have Matt Lazzetti with us, and of course Michael McKee with a breathless set of Thursday data. Lisa Abramowicz, revisions in the air. Who knows? The mystery.
What is the bigger downside risk to markets right now? What is the bigger downside risk, I would say, to bonds yield up further? Is it the potential for downside surprises? No. It is the idea of being revised upward, that maybe we are underestimating how much strength there is in the economy.
Claims in at 204,000. McKee will talk about that, but he is waiting for the prints there on our gross domestic product. Michael McKee.
Well, we just got the revision, and it isn't very big. GDP goes from 2.1% to 2.1%. Personal consumption, though, revised down from 1.7% to 0.8%. We'll look at the overall data to see where any other moves might have come from, but that's not particularly good news for the economy, although this is such old data, does it really matter at this point? The initial jobless claims number is kind of fascinating, 204,000. Wow. That's up from 202,000 last week, but this is the week you would have thought you might have seen some auto workers on the unemployment rolls, because if you're on strike, you're not eligible, but if your plant is shut down because because some people are on strike, then you do get eligibility, but apparently we didn't see any real filing there. Continuing claims, 1,670,000, that's up a little bit from 1,658, but basically little change. Labor market stays tight. I would be surprised, well, first of all, I would be surprised maybe at this point if we get jobless claims next week, because the government may be shut down, but if we get government jobless claims next week.
Are you the one guy at Bloomberg that gets to take off if
no,
I'm city?
Considered accepted and essential, but what I have to convince them is that doesn't mean I can't be paid.
There you go.
And the government, you can't be paid, but in this...
I mean, I got. Let me do the data here, Mike, while you dive into this. Got a little easing here. We had a 462, 463 on the 10-year yield. We come in 2 basis points, and having a little bit of a lift, Lisa, in the equity markets. I guess it's you nailed this earlier, where like, okay, big so what? And maybe that's the headline here on revisions, so what?
Well, there was a fear that you could get revised to the upside, and suddenly there's even more strength and momentum behind the growth and the upside surprises in the economic data than we've seen. We didn't see that in the revisions. We did see that potentially, but just incrementally on the jobless claims. You are seeing, though, markets just basically the worst case scenario for them didn't materialize, and so you're seeing maybe a bit of a pause. Hard for me to give any narrative to this. 3
basis points in the 10-year after the last two tumultuous days. Mike McKee, one more insight before we drag in Matthew Lazzetti at Deutsche Bank.
Well, everybody's talking about what the stock market's been doing, and here's an interesting number. Profits, which in the GDP report includes not just public companies, but private companies as well, were revised upward by $17.5 billion to $6.9 billion. So maybe American companies were making a little more money in the second quarter than we thought. I don't know that has a lot of relevance for today, but it does seem interesting. I'm looking, and I'll see if I can find the update, the revisions that you have been looking for, and see if there's any kind of interesting news in that.
McKee, in the next hour, will give you much more on this. Revisions back to Woodrow Wilson. We'll see how that goes. This afternoon, Mr. McKee in conversation. This is really an interesting interview. Why is Barkin different, Mike, quickly? Why is Barkin different?
because he comes at it from a business perspective. He worked at McKinsey for years, and he's spent a lot of time in corporate boardrooms. So he brings that business contact, business expertise thing to the Fed.
Look for that today. Michael McKee and Barkin. Joining us now, Matt Lazzetti, Chief U.S. Economist at Deutsche Bank. Matt, I'm going to do some amateur Tom Keene math here. I'm going 2.1% plus 1.7% GDP price index. I got nominal GDP in the vicinity of under 4%. Is that the new trend where the animal spirit finally ebbs away?
Yeah, I think it's certainly some slowing in the GDP deflator number shows some slowing there. I think as I look at the data, it's important. Getting a full sense of the revisions takes some time here, but when you look at what the revisions were to Q2, core PCE was unrevised, so it didn't really tell you a different story about the near-term inflation trend. I think that's really important. A big downward revision to consumer spending, which is surprising at this point in time. We know that there was a big pickup during the summer months, but I've been highlighting, if you look at the BEA's credit card spending data, it slowed materially throughout September. So I think, as you look at what's been happening in markets, as you've seen consumer discretionary stocks coming off a bit, we've been concerned about the headwinds facing the consumer. I think we're seeing it in the high frequency data coming through, but you're still in this fuzzy period of time here where it's unclear if it's just a give back from the strong summer months that we had, or whether it's a new trend on the consumer of weakening.
Is there a stronger signal that you're getting from the jobless claims that just keep coming in at incredibly low rates?
Yeah, I think when you look at the labor market, the consistent story is one in which labor demand is coming down materially, and that is leading to a labor market that is no longer extraordinarily tight, it's no longer very tight, but it just looks historically tight. But at the same time, there's not much evidence of layoffs taking place. That's true in the JOLTS data, it's true in how people are perceiving their job opportunities, it's true in the unemployment claims data so far. The key question will be, if the consumer does slow, as we continue to anticipate as these headwinds hit, can that story remain true? Can you continue to have a slowing labor market that is only demand driven?
When you talk about a fuzzy period of time, and this is important because we've been talking about how we don't know that we're not in a soft landing until it no longer is there a historical corollary that you look to where there is a period of slowing consumer spending but a very robust labor market? Is that something that can be a persistent feature of an economy for a prolonged period of time?
Yeah, I think we're coming out of this very unusual period, and so we're kind of prone to say that everything is very unusual about what we're seeing. With the labor market, it is typically nonlinear. So it is often the case that things look generally okay until you have a shock and layoffs pickup. That's the SOM rule, where if the unemployment rate rises by 50 basis points, you have a recession, and it always rises by more. So from that perspective, I don't know that there's all that much that's unusual here. Certainly from the lagged effects of monetary policy, people are pointing towards it not hitting as much. The key question is, did it not tighten or hit as much because we had a lot of latent fiscal stimulus in the system, and it's now beginning to bite? That's our view, but there's a lot of uncertainty about whether that's the correct view at this point.
Right now, the data check, folks, let's do that. We got green on the screen. We're up 0.3% on the SPX. The VIX comes in nicely, sprightly from an 18 level into 17.94. 10-year yield in 3 basis points off the announcement of claims. Really quite good, 204 with a constructive leveling revision of 202. And we've got the GDP numbers here. Let's stagger over to Michael McKee for an insight. He's got the Bramo cam. I caught on the Bramo cam. McKee going, let me in. What do you got?
Well, we do have the revisions here, and it does solve one of the mysteries, or at least brings us closer to an answer of why gross domestic income has been lower than gross domestic product. It's because gross domestic product was over measured. Right now, the government says that the GDP from the fourth quarter of 2019 to the second quarter of 2020 was down 17.5%. That is up 0.7 of a percentage point. But when the expansion started again from 2020, the fourth quarter of 2020 through the first quarter of 2023, GDP was up 5.6%. That's 0.2 lower than had been originally estimated. So it brings those numbers into a little bit more agreement.
There's the heart of the matter to both of you, Matt Lazzetti and Mike McKee. Does this allow the Fed to change course? Does it give them cover to change tone?
I don't think so. I mean, when you're looking at Q3 trackers, we're at 3.8%. You have the Atlanta Fed closer to 5%. Do you see the jobless claims data here today? The real-time evidence that we have in terms of what happens with the labor market and the growth data so far for Q3 I think all fits with them maintaining this hawkish bias, the threat of another rate hike that's out there. We don't think they deliver on it, but I think that fits with them sticking with that story.
When you talk about, you don't know whether we're seeing the lag and variable effects coming into play now. We don't understand why they didn't happen earlier. We don't understand a lot about this economy. What is your compass, right? Especially at a time where we might not be getting data from the government because of a government shutdown. What is the most important data that you're tracking? Is it credit card spending? Is it jobless claims? Is it something else, the sort of intangibles that some of the Fed officials have said in the conversations with small business owners are the most important?
Yeah, I think in a period where you're not getting the key macro data, you have to rely on some of these other alternative data sets. The anecdotes that we might get, the surveys from the ISMs and those types of surveys will be incredibly important, I think, for distilling what's happening with the economy. But I think it's all about the consumer and it's all about the labor market. We've done some research in the past which suggests that continuing jobless claims are the best real-time indicator of recession. Right now, they're clearly not telling you that we are in a recession. They don't lead significantly, but they tell you when we are in a recession. And so I think that remains the key data point. From a consumer perspective, I think it is this card spending data. It gives you kind of a weekly view on how things are evolving. It's volatile. It has seasonal adjustment issues, so there's a lot of trickiness in it. But if you smooth through what we look at over a 4-week basis, it's slowed materially over the back half of August and then into September.
Is it coherent with this idea that you could see a sharp spike upward in the unemployment rate? Or is that still very unclear in your view?
No, I think if we have a slowdown where growth goes into negative territory and the consumer actually begins to contract, with how much labor demand has come down, I would not be surprised at all to see the unemployment rate begin to move higher. It's kind of part of our baseline forecast. Timing that exactly when that happens is always very difficult.
Mike, in this fuzzy period of time, Michael McKee, what is the Fed going to do if they aren't getting data?
They're going to look at whatever data they have, and there's a lot of private sector data out there, although it's not going to be as accurate or as good. One interesting aspect is that ADP is out, and we all talk about every time ADP comes out that it doesn't match up with what happens with non-farm payrolls. But the Fed gets ADP's data and creates its own index from that. And we do not know if their own index is better, but it might give us some answers about jobs. It might give them some answers about jobs. The interesting thing is going to be how long this lasts, because the September data is all in, so, or will be after today. So if they can put it out, the Fed can have it. If they can't, then the Fed has to kind of fly blind and try to figure out from their own data sources what the best course of action is.
That's our only hope is here at Surveillance. We look at the data sources. They're off to Bloomberg, and equities give way here, up nicely off these data points. We give it back now. Futures up 5, Dow futures up 51. VIX back above 18.16. In the yield space, round trip, 463. Down to a 460, and we've come right back as people digest revisions. They digest what I think McKee said about down we went in the pandemic and it was not as worser, and then we came back and it wasn't as good. I think I analyzed that correctly. 210 spread pretty much unchanged as well. And the 10-year real yield, wow. 2.28%. That's a wow statistic. The Standard & Poor's 500, Lisa, up 0.1%.
To me, the focus really has been on some of the tumult in the bond space that really hasn't been seen by the stock space. And Matt, from your perspective, I would love to know whether you think that stocks are just completely ignoring bonds, whether bond yields here make sense economically based on your forecasts.
Yeah, I think when I take a step back, what has been very unusual in the rates market has been how much rate cuts have been priced. You never see that happen when you're in the midst of a rate hiking cycle. And so that part has been very unusual. We are getting back to more normal environments from a rate cutting perspective as the Fed has led to this higher for longer repricing. But what we're seeing is that filter through into the high real yields that Tom's mentioning. It is beginning to shake some of risk markets. You know, you do see equities down, particularly for some of those cyclical sectors. That's a really important dynamic. I think it's beginning to tighten financial conditions from the Fed. And as I take a step back, you know, we have this view that the Fed is going to be cutting rates materially next year. Interestingly, I think a precondition for that was that the market didn't price it. Because by the market not pricing it, you actually get real yields higher, you get financial conditions tighter. It ultimately makes a higher likelihood that the Fed does deliver on that by weakening the economy.
Quickly, are we restrictive now?
I think if we maintain real yields in the levels that they are, we are sufficiently restrictive and the Fed doesn't raise rates again.
Matt Lazzetti, thank you so much. And that 10-year benchmark I use, 2.28. Lisa's sophisticated. She looks at the 5-year real yield, which a lot of pros do. They come in tighter to where maybe there's some elasticity or sensitivity to the American economy. 2.29% on the 10-year real yield. Extraordinary. Futures up 3. The 10-year yield 4.64%, launching out here again to a higher yield. It's going to make for an eventful day, an eventful 2023. Thierry Weissman joins from Macquarie. We do that next. Stay with us. Bloomberg Surveillance.
U.S. consumer spending rising at the weakest pace in over a year. That is really probably the headline from the revisions that we got to the GDP. Welcome back, Tom Keene, Lisa Abramowicz, John Ferro off preparing for his 9 a.m. And we are seeing for at least 20 minutes. And so we are seeing a bit of a pop on the heels of data that at least didn't surprise the upside. I think we could say, just to really annoy people, that bad news right now or weaker news.
It continues. Moments ago, 4.66% in the 10-year yield. And I'm sorry, these are markets moving off of the measured comments we heard from Michael McKee. There's no other way to put it.
Well, I think that that's as good an explanation as anything, because it's very hard to understand exactly the dynamic behind some of these yield moves moving out to new post-2007 highs. I do want to bring you some specific names that I find interesting, because when you take a look at the earnings reports, they are already starting to trickle out pre-JP Morgan October 13th, including CarMax that came out earlier today. If you want to know where you are seeing the effect of higher rates, CarMax is a fantastic candidate, because you are seeing people not buy as many cars because auto loans are really expensive. And so that is weighing on the used car business, and you are seeing it in a material way with those shares lower by 12%. This is the kind of granularity that actually, to me, speaks volumes about where the pressure points are for the consumer.
Well, you're on the edge of Greenspan there. And, I think of what Ed Hyman does with freight and other measurements here, as we just heard from Matt Lazzetti and his focus on credit cards and the consumer. And that was the moldy number at 8:30, was the consumer was tepid.
Exactly, which is the reason why some of these earnings are so interesting. Accenture, another software consulting company, also coming out this morning and coming in with a lower than expected fiscal 2024 sales growth outlook. Again, heavily punished, even though it wasn't that significant of a miss. 5.1% declines in those shares in Micron yesterday after the bell came out with earnings that also disappointed. And so you could see a similar kind of move in the shares, lower by 3% at a time. We were talking about Apple's strength, but smartphones more broadly are not showing that kind of strength, and that weakness seems to be persisting.
I'm using the Bloomberg terminal here, and in fact, it's markets on the move as you bring in Thierry Weissman. I mean, they got the 2-year yield buttressed up against new highs. Rounded up 5.14, but I have a new high in the 10-year yield and in the 10-year real yield. I can't even frame the amber screen of a 2.31% 10-year yield. That is not in my ability to think 90 days ago.
And it looks like a moonshot in terms of the pace of moves, which raises the question, does this bond move make sense? Does it make sense for yields to be at this level? Terry Wiseman's been covering this for decades, and you've watched this market transform. Global interest rates and currency strategist at Macquarie. Does this bond move make sense to you right now?
It only makes sense if you take the recent guidance from the central banks literally. If you don't do that, then these don't make sense. What do I mean by that? Central banks were hiking around the world until recently. Some of them still are, like the Fed. But they did shift their guidance recently to talking about stopping the tightening cycle. What they didn't do was to shift from that to talking about flexibility in 2024. There was instead they adopted a transitionary guidance, which is this so-called high for long. I think the Fed, through the dots and through Chairman Powell's press conference and rhetoric, have been trying to guide the market towards having the market think that rates will stay high for long. And if you believe that this is the case, well then yes, the 10-year at 4.6 may make sense. Of course, we know that the Fed can pivot often, and often it does. And if we see the economy weaken, which we believe it will happen, then in retrospect, these 10-year yields at 4.6% will not make sense.
As we talk, we're reaching new post-cycle highs. I mean, this really is amazing to watch. 4.67% and climbing. There is a question. Yes, we cannot see, we don't have a crystal ball. We can't see into the future. But when you take a look at all of the market action, is it coherent that stocks are hanging in there? Is it coherent with a 4.67% 10-year yield?
Yeah, you would think that with yields as high as they are, that multiples would be lower, especially for the growth stocks in the index. I agree that they should be. I think what the market is losing sight of maybe is that there is going to be a recession. And I think that the trigger for lower stocks will be exactly lower earnings estimates that come out of the slowdown that we anticipate happening over the next few months. When that happens, then you'll see that reconvergence, which is long overdue, admittedly.
You have profound experience at this, going back to the John Riding and David Malpass team at Bear Stearns, of synthesizing eco-babble into, okay, folks, what are we actually going to do in the market? How do you link right now all the economic wins into positioning for 2024?
Well, I think you take what Lisa, you infer from what Lisa's earlier question, that there's this huge divergence in valuations between bonds and stocks. It's evident if you just track earnings price ratios and bond yields over time. There has been a correspondence, but in the last few months there has not been. If you're a relative value trader, that's exactly the kind of divergence you look at. So implicit in her question was that there is a divergence in valuation. I want to take advantage of that as a trader. I'd be selling stocks, buying bonds. I like the 10-year at 4.6%. I don't like stocks at these
What about
valuations.
our audience that can't be that sophisticated, an audience that has retirement plans and they can't set up some form of long-short Julian Robertson hedge? How do people in the real world act here?
Cash looks good, right? If you can get 5.4% these days on a time deposit or certificate deposit at your local bank, take it.
Yeah,
take
Lisa,
some assets out of the bond market, maybe. Take some assets out of the stock market. Gain peace of mind with those high yields. They are above inflation.
2-year yield, 5.15%. When do we start framing out 6% stuff like a money market fund?
I'm not understanding this move. I'm not understanding if this is forced selling, if this is a strike by buyers. Is this bond vigilantes? Is this something that's truly a fundamental reset that we're seeing of views? Because that's not what I'm feeling. I'm not feeling conviction by anyone saying, all of a sudden, I have a new view for markets.
Look, I think the move in bond yields up to about the 4% level was a fundamental a repricing of the bond market, right? We do have evidence these days that there are structural reasons to believe that the last mile of inflation reduction, say from 3% to 2%, will be very tough. And that the Fed does need to keep rates well above zero to get that there indefinitely. What doesn't make too much sense to me, like I said before, is the new guidance. The idea that you can look forward that far into the future, into 2024, into 2025, into 2026, and believe that you're not going to get back down to your target by then, that inflationary pressures will be too high to allow you to do that, seems as if it's sticking your neck out quite a bit too far for the Fed. And I would rather, again, that they would have adopted a more flexible outlook for the medium to long term. I think, and let the bond market just reprice of its own volition on the view that the Fed will be flexible and more data dependent on a long-term basis, not just a short-term basis. If that were to have happened, I think the bond yield would have settled somewhere just above 4%, maybe 4.2, but not the big ratcheting up that we've seen in the last few weeks.
Take it globally, Macquarie of Sydney in Australia. Take it out to, in this case, the United Kingdom. Moments ago, real dynamics that we see in the 10-year gilt. Ferro calls them the gilt market. In the gilt market, a nice leg up here as well. Is Chairman Powell central banker to the world? Is it's a global correlated bond move, or is it discrete to the United States for him?
It is correlated, but I would add that in the last few days, you've also seen this high for long narrative emerge from the other central banks as well. It's as if implicitly they're forced to somehow follow the Fed with regard to their own narrative. So, for example, Christine Lagarde gave a speech before the European Parliament a few days ago, or an address, and she also mentioned high for long. And we've seen the chief economist at the BOE mention high for long as well, as recently as a few weeks ago. So they're all picking up on this mantra.
Just quickly, are we seeing something break right now in markets?
I think we could see something break, right? When you see this kind of volatility, especially in yields, perhaps in commodities like we're seeing in oil, it's the concentration of risks that will cause something to break. What do I mean by that? You just don't know who's swimming naked until the tide goes out, to use the old figurative analogy.
Warren Buffett.
Exactly. Yeah. And so, yes, the presumption here is that there's something out there that will break. Right. What it will be, we don't know. Could it be micro? Yes, but it could also be macro. It could be the regional banks again with respect to their holdings of commercial real estate. That can certainly break if this bond move causes a massive repricing of office properties.
I barely mentioned it today, but that's where I'm looking, commercial real estate, and we've heard, of course, about cost of capital from BlackRock today as well. Dr. Weissman with Macquarie, a brilliant guest at an important time here as markets unravel. Quickly on the data check, I've got 5.14 2-year yield. It's up a basis point, maybe not leading there. Out the curve is where you're seeing price down, yield up. I have 4.67 10-year. Moments ago, a 4.80 30-year as well. Coming up today across Bloomberg Television and Radio, an important conversation. First, Vice President Pence, Mike Pence, will be at the Anne-Marie Horton and Joe Matthew in the 1 o'clock hour. And then the economic conversation of the day, Barkin of Richmond, hugely qualified of the linkage of business to the Fed, our Michael McKee in conversation with Tom Barkin. Stay with us. This is Bloomberg